बैठे रहें, इंतजार।
ठीक है, चलिए ये है आपके लिए व्यू। टाटा कम्युनिकेशंस थोड़ी नरमी के साथ खुल रहा है सर, कुछ ज़्यादा यहाँ पर इम्पैक्ट नहीं आते हुए दिख रहा है। कैनफिन होम्स भी करीब 1% नीचे आपको खुलते हुए दिख रहा है, अगेन इस पर भी कुछ ज़्यादा इम्पैक्ट नहीं है। एल&टी फाइनेंस 3-3.5% ऊपर खुल रहा है, तो सबसे बड़ा रिएक्शन एल&टी फाइनेंस।
एल&टी फाइनेंस 4 से 5% तक की तेजी बनती है हमारे हिसाब से, लगभग उतना खुल भी रहा है। 139-40 बस इतना ही है, इसके ऊपर भी नहीं लग रहा, और बैन में भी है। तो अब देखो क्या होता है, शॉर्ट कवरिंग थोड़ी रहेगी। टाटा कम्युनिकेशन फ्लैट खुल रहा है, फ्लैट। टाटा कम्युनिकेशन नीचे
1% नीचे,
तो टाटा कम्युनिकेशन आराम से दीप नीचे आने दो, नीचे आए तब खरीदना है। अभी कुछ करने ऐसा जरूरी नहीं कि आपको कुछ करना है, तो मेरे ख्याल से 1570-80 आए, उसके बाद देखा जाए कि क्या करना चाहिए। सो आई थिंक टाटा कम्युनिकेशन में भी वेट करिए। और तीसरा कौन सा था, कैनफिन होम्स
1%
नीचे
नीचे।
हाँ, तो थोड़ा इंतजार करें, सब भागे हुए स्टॉक है ना। 50% 3 महीने में भागे हुए शेयर, तीनों शेयर 50% भागे हुए। तो 3 महीने पहले किसी को तो लगा होगा ना 3 महीने बाद अच्छे रिजल्ट आएंगे, तो आराम से हड़बड़ी ना करें।
ठीक है, जियो फाइनेंशियल का डीमर्जर हो रहा है, रिलायंस इंडस्ट्रीज में स्पेशल प्री ओपन सेशन चल रहा है, फिलहाल 2650 दिख रहा है।
हाँ, तो बिल्कुल ठीक है, हमारा अंदाजा है उसके आसपास
200 के आसपास की वीकनेस दिखी थी, वही 2650 के आसपास ट्रेड कर रहा है। ओके, ये है आपके लिए राय इस समय अपनी पर। एक बार सेठी साहब से भी टाटा कम्युनिकेशंस पर राय लेने, क्योंकि सेठी साहब भी इसे ट्रैक करते हैं। सेठी साहब, नंबर्स पर आपका कोई व्यू और ऑफ कोर्स आगे का आउटलुक बताएं सर।
बिल्कुल दीपांशु, देखिए बहुत ही अच्छी क्वालिटी का स्टॉक है, कई बार मैंने रिकमेंड किया, और अनिल जी के स्पेशल 25 का भी ये स्टॉक रहा है उसका। लॉन्ग टर्म पे तो मैं बहुत ही बुलिश हूँ इस स्टॉक पे। बाकी आज क्वार्टरली नतीजे बहुत ज्यादा तोड़फोड़ नतीजे नहीं है, और स्टॉक ने पिछले कुछ दिनों में एक अच्छा परफॉर्म किया, तो उस लिहाज से थोड़ी बहुत प्रॉफिट बुकिंग आना स्वाभाविक है। बट जिन्होंने लिया हुआ है उनको बिल्कुल इस स्टॉक को भूल जाना चाहिए, मतलब होल्ड करके रखना चाहिए, और एक लॉन्ग टर्म के लिहाज से इसमें बने रहने की सलाह रहेगी। आई एम एक्सट्रीमली बुलिश ऑन द स्टॉक।
तो ये है आपके लिए टाटा कम्युनिकेशन, एक्सट्रीमली बुलिश ऑन द स्टॉक, और हमारी तो स्पेशल 25 का काउंटर है भी ये। एक दो काउंटर्स जहां पर आज नतीजे आने वाले हैं उस पर भी व्यू लेना जरूरी है। वागले साहब, इन्फोसिस जरा देखें, रिसेंटली अच्छा रनअप रहा है, आज नंबर्स आएंगे, उससे पहले इंपॉर्टेंट टेक्निकल लेवल्स क्या बनते हैं सर इन्फी के लिए?
दीपांशु, इन्फी ने, ये मैं फ्यूचर्स के लेवल्स अभी देता हूँ, मार्केट ओपन होने को है, तो लगभग 1440 का एक इम्पोर्टेंट रेजिस्टेंस तोड़ दिया है 2 दिन पहले। तो मेरे हिसाब से 1440 1445 के नीचे जाना नहीं है। उसके ऊपर का पहला टारगेट अभी 1525 का है, तो 1440 1525 ये इन्फी की रेंज होगी।
ओके, ये है आपके लिए इन्फोसिस। HUL, सुमित जी जरा इसका चार्ट एक बार देख लें और बताएं इसके लिए इंपॉर्टेंट लेवल्स क्या है, आज इसके भी नतीजे आएंगे सर।
जो स्टॉक के अंदर पिछले कुछ दिनों के अंदर साइडवेज मूव मिला है, मेरे को लग रहा है कि ओवरऑल पोजिशनल व्यू के तौर पे डिप में खरीदारी करना है, एग्जिस्टिंग पोजीशंस होल्ड रख के चलना है। स्टॉक में कोई भी डिप आता है 30-40 रुपए का, तो लोअर लेवल्स पे खरीदारी करें। 2640 2630 ये स्टॉक का नीचे में सपोर्ट है। ऊपर के अंदर 2700 के इमीडिएट टारगेट होंगे, और 2700 का लेवल निकलने के बाद 2800 रुपए तक के लेवल आने वाले दिनों में HUL में देखने को मिल सकते हैं। डिप में खरीदारी करें, एग्जिस्टिंग पोजीशंस होल्ड रख के चलें।
यूनाइटेड स्पिरिट्स, बंसल जी एक बार इस पर राय दे दें, नंबर्स भी आने वाले हैं, और कल 2000 में अनिल जी ने मेंशन भी किया था इस काउंटर को। चार्ट्स क्या कहती हैं सर?
दीपांशु, चार्ट्स भी अगर आप देखें तो एक्सट्रीमली पॉजिटिव है। ऑलरेडी स्टॉक के अंदर एक ब्रेकआउट हुआ है, तो जिनके पास है क्लियरली बने रहना चाहिए, और करेक्शन पे स्टॉक 940 945 के अराउंड मिल जाए तो खरीदना चाहिए। एक ब्रेकआउट ऑलरेडी देखने को मिल रहा है, और टेक्निकली 1035 1050 के टारगेट्स बैठते हैं, तो 1035 1050 के लक्ष्य के लिए गिरावट पर खरीदारी की राय है।
ओके, तो ये है आपके लिए सारे के सारे स्टॉक्स जिन पर आज है भरपूर एक्शन। आइए इसी एक्शन को बढ़ाते आगे। घंटे की मधुर आवाज आपके कानों में आती हुई दिखेगी। मधुर में इसलिए कह रहा हूँ कि मुझे तो लगता है हरे में खुल सकते हैं, फिर देखो क्या होता है। नीचे खुले तो भी मौका होगा खरीदारी का, ऊपर खुले तो कहना है क्या। 19800 19850 ये 50 पॉइंट की रेंज में देखिए टाइम पास होता दिखा। 19850 के ऊपर से मजबूत होना शुरू करेंगे, 19800 के नीचे से हल्की फुल्की कमजोरी फील करना शुरू करेंगे। और बैंक निफ्टी में भी वही हाल है, नीचे में 45500 जब तक नहीं टूटता, उसके नीचे नहीं जाता, तब तक आप मजबूत रहेंगे, और ऊपर में 45800 के ऊपर से और मजबूत होना शुरू करेंगे। तो रेंज बाउंड ट्रेड की उम्मीद ज़्यादा है। आज 7 पॉइंट ऊपर खुलता हुआ हरे निशान में, और 4 पॉइंट ऊपर खुलता हुआ सेंसेक्स हरे निशान में। बैंक निफ्टी 25 पॉइंट ऊपर है, पहली टिक पे कम से कम हरे तो दिखे हैं। अब सेंसेक्स पूरा 25 पॉइंट नीचे है, निफ्टी 5 पॉइंट ऊपर है, और बैंक निफ्टी अब लाल निशान में 20 पॉइंट आता हुआ दिख रहा है। तो बिल्कुल शांत शुरुआत, हाल ही के दिनों की सबसे शांत शुरुआत भारतीय बाजारों में होती हुई दिखी है। मूड बनाने में लगे हुए हैं बाजार, किधर जाएं किधर न जाएं, जो हम कह भी रहते हैं कि आज आराम से शुरुआत में मूड बना लीजिए, डिसाइड कर लीजिए क्या करना है। कल ही के लेवल के आसपास ट्रेड करते हुए दिख रहे हैं निफ्टी, सेंसेक्स और बैंक निफ्टी। कोई बड़ी मूव ऊपर या नीचे की तरफ आपको नज़र नहीं आएगी। वजह साफ है कि संकेत इस तरह के हैं कि ना बड़ी तेजी हो रही ना बड़ी मंदी, लेकिन किस लेवल से सपोर्ट लेकर घूमता है निफ्टी, उस पर फोकस जरूर करिएगा। ओके, पहली टिक आपके जो आ रही है, इस पर एक बार मैं इंडेक्स पे आपको बता दूं कहाँ पर एक्शन है। एक भी स्टॉक इंडेक्स में ऐसा नहीं है निफ्टी में जो 1% ऊपर या 1% नीचे खुला हो। स्टॉप गेनर है डॉक्टर रेड्डीज 0.1% ऊपर है, पावर ग्रिड 0.1% ऊपर। तो ये दो स्टॉक हैं मजबूत। डीवीज में 0.5% की तेजी, आईसीआईसीआई बैंक 0.5% मजबूत है, एनटीपीसी 0.5%। तो एक चीज़ साफ दिख रही है, एनटीपीसी, पावर ग्रिड जैसे शेयर ये बता रहे हैं कि कुछ सरकारी कंपनियां और साथ ही पावर कंपनियां चलने को तैयार है। बीपीसीएल भी 0.5% मजबूत खुलता हुआ। कल का कुणाल जी राकेश जी का पिक ऑफ द डे, और आज कुणाल जी का पिक ऑफ द डे, कल नहीं कुणाल जी राकेश जी का कल पिक ऑफ द डे एचवीसीएल था, नॉट डे। तो ये भी मजबूत खुलता हुआ दिख रहा है। कमज़ोर क्या है? एचसीएल टेक 1% नीचे, इन्फोसिस 0.5% नीचे है, और साथ ही साथ अल्ट्राटेक और हीरो मोटोकॉप ये दोनों नीचे। तो थोड़ी थोड़ी कमजोरी वाले स्टॉक्स आपको नजर आएंगे आईटी स्पेस से, ये हल्के फुल्के कमजोर होते हुए। इंडेक्स बता दूं वही 19,830 के आसपास है, नीचे में 825, उसमें ऊपर में 845। 20 पॉइंट की रेंज में निफ्टी ने अब तक कारोबार किया है, और बैंक निफ्टी नीचे में 45,640 और ऊपर में 45,740। 100 पॉइंट की रेंज रही है। हरे लाल निशान के बीच में झूलते हुए बाजार वायदा कारोबार की तरफ आइए। टॉप गेनर है, कौन को 1.5% ऊपर ही, इसको बाहर नहीं निकालेंगे क्लास से, और इसी में इसको लगा कि मेरा रिजल्ट बहुत अच्छा है खुश है ये, तो 1.5% बना रहेगा वायदा कारोबार में। टाटा कम्युनिकेशन ये भी 1.5% मजबूत है। नतीजे के बाद जो हम कह रहे थे कोर रिजल्ट अच्छे हैं दीप, तो प्री ओपनिंग सेशन में भले ही नीचे दिख रहा था, मजबूत होता हुआ। एल&टी फाइनेंस जितना मजबूत था 139 हम बोल रहे थे, 139.40 से ऊपर जाएगा नहीं, 139.55 का हाई बनाकर थोड़ा सा 1% मजबूत आपको नजर आएगा अब एल&टी फाइनेंस। फेडरल बैंक का क्यूआईपी खुल चुका है, 1-1.5% की तेजी यहाँ दिखेगी। इंडस टावर आज फिर से 1% मजबूत खुलता हुआ दिख रहा है, यहाँ अच्छा एक्शन दिख रहा है। डीएलएफ 0.5% मजबूत है आज के सेशन में, जो सेठी साहब ने भी पसंद किया अपने पिक ऑफ द डे में। उसके अलावा पावर ग्रिड जैसे शेयरों में अच्छी तेजी आपको दिखेगी। पॉलीकैब लगातार तीसरे दिन मजबूत है, बैन में होने के बावजूद हरे निशान में खुलता हुआ। शी सीमेंट जी बिजनेस ने 11 जुलाई को आपको एक्सक्लूसिव खबर दी थी कि एमसीए भी अब खातों की जांच करने की तैयारी में है, लेकिन उस समय कंपनी का खंडन आया था कि ऐसा कुछ भी नहीं हो रहा। लेकिन फाइनली अब कंपनी ने कहा है कि हाँ, उन्हें नोटिस मिल चुका है, एक्सचेंजेस को इन्फॉर्म किया। इसके बाद 2.5% के नुकसान के साथ शी सीमेंट टॉप लूजर। कैनफिनोम 1% नीचे नतीजे के बाद, इन्फोसिस 1% नीचे नतीजे से पहले। आज आने वाला रिजल्ट पहले भाग चुका है। थोड़ी प्रॉफिट बुकिंग, आज थोड़ी प्रॉफिट बुकिंग एफएमसीजी स्टॉक्स में दिख रही। तो अगर आप शॉर्ट साइड पर आइडिया ढूंढ रहे थे, शायद ये एक स्पेस है जो दबाव में। ब्रिटानिया, डाबर, नेस्ले, आईटीसी, ये सारे एफएमसीजी स्टॉक्स आज प्रेशर में आपको नजर आएंगे। ये है शुरुआती कारोबार का रुझान। लाल हरे निशान के बीच में झूलते हुए बाजार अब थोड़ी सी कमजोरी निफ्टी पर बढ़ती हुई 19,800 के इंपॉर्टेंट लेवल की तरफ पहले आता हुआ। तो अभी तक 19,800 19,850 की रेंज को होल्ड किया है। लेट्स सी व्हाट हैपेंस नेक्स्ट। लेकिन बैंक निफ्टी बेहतर है, थोड़ा सा कल ही के लेवल के आसपास ट्रेड करता हुआ 100 पॉइंट नीचे आपको नजर आएगा। सेंसेक्स ये है आपके लिए अब तक का।
हल्की खरीदारी अनिल जी मिड कैप स्मॉल कैप इंडेक्स में आ रही है, रखिए इस पर नज़र। पीएनसी इंफ्रा जो ऑर्डर आ रहा है इनके लिए, उसके दम पर करीब 5% ऊपर ये काउंटर ट्रेड कर रहा है। यूनियन बैंक में खरीदारी है, 2.5% ऊपर दिखेगा। ग्लैंड फार्मा 2.5% ऊपर है। चोला फाइनेंस 2% ऊपर दिखेगा। मैनकाइंड फार्मा में भी खरीदारी हो रही है। कजारिया सिरेमिक्स अच्छा दिख रहा है। आपार इंडस्ट्रीज पॉजिटिव है। सीआई ऑटोमोटिव 2% ऊपर है। आईडीबीआई बैंक, एमआरपीएल, EIH, बीकाजी फूड्स, यूको बैंक, श्याम मेटालिक्स, इंडिगो पेंट्स, यहाँ पर भी आपको पॉजिटिव रुझान ही दिख रहा है। इलेक्ट्रा ग्रीन टेक पर भी रखिएगा नजर, और साथ ही नजर रखिए कृष्णा डायग्नोस्टिक्स, इनके लिए नेगेटिव खबर आई है। और प्रीमियर एक्सप्लोसिव्स जहाँ पर थोड़ा प्रमोटर एक्शन भी हुआ है। एंजल वन यहाँ पर 1.5% की खरीदारी आपको दिख रही है। वीकनेस कहाँ पर है? अमर राजा लगातार दूसरे दिन कमजोर है, 0.25% की गिरावट दिखाता हुआ। जेंजा टेक्नोलॉजीज में 1% की गिरावट है। पेटीएम इसमें थोड़ी नरमी है, आई थिंक कल इसके नतीजे आने वाले हैं। साथ ही ग्राफाइट इंडिया ये 1% नीचे है। मैक्रोटेक डेवलपर्स में हल्की सुस्ती दिखेगी। एस्टेडियम हेल्थ केयर, एलगी इक्विपमेंट्स, कल्याण ज्वेलर्स, साथ ही जैसे कुछ काउंटर्स हैं जहां पर आपको वीकनेस दिख रही है। अनिल जी, मिला जुला रुझान है 19,800 के थोड़ा नीचे है। निफ्टी 35 पॉइंट की कमजोरी, 25 पॉइंट की मजबूती आपको बैंक निफ्टी पर दिख रही है। मिड कैप स्मॉल कैप में स्लाइट आउट परफॉर्मेंस आ रही है। एंड ऑफ कोर्स रिलायंस के स्टॉक पर तो हमारी नजर बनी ही हुई है। आईटी, जैसा आपने कहा सर, आईटी, एफएमसीजी, फार्मा, ये तीनों डिफेंसिव थोड़े कमजोर दिख रहे हैं। बट सेक्टोरियली अगर बात करें तो कोई भी ऐसा बड़ा सेक्टर नहीं है जो बाजार को संभालने की कोशिश कर रहा हो। थोड़ा ऑयल एंड गैस और पीएसयू स्टॉक्स में एक्शन आपको दिख रहा है, बट क्लियरली आईटी की वीकनेस का इंपैक्ट इस समय बाजार पर आपको दिखेगा। कई सारे कैश के कॉल्स भी हैं जहां पर आपको रखनी चाहिए नजर। मूव आपको इंटरेस्टिंग आ रही है वहां पर। बट आइए स्टॉक्स की बात करें, और डॉक्टर रेड्डीज 1% ऊपर, सिटी साहब ने इसकी बात भी करी थी। अच्छे मोमेंटम में रेड्डीज आपको दिख भी रहा है ओपनिंग पर। वागले साहब से एक बार राय भी ले लेते हैं। वागले साहब, डॉक्टर रेड्डीज ओपनिंग पर थोड़ा मोमेंटम दिख रहा है, कोई ट्रेड की अपॉर्चुनिटी बनती है सर?
दीपांशु, अगर पोजिशनल व्यू है तो यहाँ ले सकते हैं, नीचे आता है तो और ऐड करेंगे। 5,240 तक अगर नीचे मिलता है तो भी ऐड किया जा सकता है। आपका स्टॉप लॉस 5,200 के नीचे होना चाहिए, और मेरा मानना ये 5,400 5,500 तक ये मेरे दो टारगेट्स रहेंगे। 2 से 3 दिनों का टाइम होगा।
ओके, तो ये है आपके लिए डॉक्टर रेड्डीज ओपनिंग पर थोड़ा मोमेंटम दिखा दो। इंडसइंड बैंक, हमारा रीसेंट कन्वेक्शन 0.5% ऊपर आज भी ट्रेड कर रहा है। कल स्टॉक ऑफ द डे में भी बात करी थी। इस पूरे हफ्ते एनजी का कन्विक्शन भी रहा है इस काउंटर पर और आपको खरीदारी दिखा रहा है। और एनटीपीसी कल का टॉप गेनर बाजार का, ये भी आपको मोमेंटम में दिखेगा। बट इन्फी, एचसीएल टेक, यहाँ पर वीकनेस आ रही है। टेक महिंद्रा, टीसीएस, ये भी थोड़े कमजोर दिख रहे हैं। सिप्ला में भी थोड़ी नरमी आई है। एक बार सिप्ला के चार्ट पर कुणाल जी से राय ली जाए। कुणाल जी जरा देखें, बाकी फार्मा ठीक है, थोड़ा सिप्ला इस समय कमजोर दिख रहा है। कोई राय सर इसके चार्ट पे?
देखिए, पिछले 3-4 सत्रों से आप देखें दीपांशु, 1030 का जो स्तर है ये एक रेजिस्टेंस का काम कर रहा है, और हम देख रहे हैं कि 3-4 बार अटेम्प्ट हुआ ये लेवल पार होने का, लेकिन पार नहीं हो पाया। तो एक क्लियर रेजिस्टेंस यहाँ इमर्ज हुई है, और वहीं से आज आपको थोड़ी गिरावट आते हुए दिख रही है। मुझे लगता है एक दायरे का कारोबार यहाँ देखने को मिलेगा, जिसमें 1000 से 1030 के बीच में स्टॉक कुछ और समय बिता सकता है। वेट एंड वॉच करें, जिनके पास पोजीशन है 1000 के नीचे स्टॉप लॉस रख लें।
Hello, my name is Mark Douglas, and I'm the author of The Disciplined Trader and Trading in the Zone. I've been a trading coach since 1982, and over the years, I've worked with some of the industry's biggest hedge fund and money managers, as well as some of the exchange's largest floor traders. I know that all of you want to experience consistent results from your trading. In other words, you want to be able to generate an income you can rely on. However, one of the major obstacles in trying to accomplish this objective is in the area of trade execution. To produce a consistent income, a trader has to be able to execute their trades without making any errors or mistakes. In other words, trading without hesitation, reservation, or internal conflict. Basically, all of the errors we are susceptible to are a result of a lack of confidence, or more specifically, trading with fear. What most people don't realize is that trading without fear is actually a learned trading skill, a skill that has to be cultivated and is the primary difference that separates the professional from the typical trader. In this series of DVDs, I'm going to provide you with the kind of insight, understanding, and specific mental techniques you'll need to learn to trade without fear, so that, like the professional, you can move in and out of your trades with the kind of confidence and ease that will allow you to take full advantage of your wise trade or any other trading methodology. Hey, hello. Yeah, good morning. And also, too, how many people came from the West Coast or in the West Coast time zone? Yeah, it's like the Wise Trade people picked me up at 6:30 in the morning, which was 4:30 in the morning for me. So when I say that, when I say this, we're here for you, and to ignore the cameras, ignore the environment, I really mean that. But at the same time, I want you guys to help me a little bit, okay? It might take me a little bit, to get going, because I'm not used to doing presentations at, 6:30 in the morning my time, or 7 o'clock in the morning my time. But anyway, what we're going to do is we're going to go through the process of learning how to think like a professional trader. Why would we want to learn how to think like a professional? Anybody got any ideas? What's that?
Make some money.
Make some money. But you don't have to think like a professional to make money, do you? What does it even imply? What does it imply to think like a professional trader? I mean, let me ask you this. How many you guys have, I don't know what your trading experience has been in terms of the number of years you've been at it, or kind of give me an idea of the demographics here of the audience. I mean, how many people have been trading for more than 2 or 3 years? Most everybody? Then less than 2 years? Kind of new people? Oh, okay. So we've got about half and half. What would it mean to you guys to say, well, let's think like a professional trader?
Then you're not thinking like an amateur.
What's that? Not thinking like an amateur. Okay, that's good. But what are the implications of the difference between a professional and an amateur?
Right, consistency.
Consistency. There you go. You see, you're at my Houston workshop, right? Yeah, consistency. Exactly. In other words, what that would imply is that if I'm a professional trader, in other words, if I've aspired to be a professional, one of the implications would be that I can make consistent money, because if I'm trading in the mode of a professional, I could be a hedge fund manager, a professional hedger working for trading companies, or just having a full-time job as a trader where my income, my sole income, is derived as a trader. And to be in that kind of a position, or to be in a position where other people are going to give you their money or give you their assets to be able to, make money for them, it would certainly imply that you can make consistent money. That there's a way for you to, let's say, create an equity curve that looks, something like this. Isn't that right? Are you going to give your money to somebody with an equity curve that looks like that? I'm not saying that people don't do it, and I'm not saying that it doesn't happen. But I'm saying that if I've aspired to be a professional trader, it means that I must have learned something that's different than the people who can't do this. There must be something about the way that I approach trading that allows me to do that. And believe me, there is. There's a lot. What's that? Cool. Yeah, cool. Basically, and I don't know how many people in the room have either read Trading in the Zone or The Disciplined Trader. We've got a few people. So probably there's actually most of the people in the group aren't familiar, maybe even with me or my background at all. True or not? Yes or no? See, no, right? Oh, okay. So I'm going to just give you a little bit, and I'll give you more later on. But I started trading back in 1978, and the first trade that I made, the first trade I made was in potato futures at the Chicago Mercantile Exchange, which they don't even trade potato futures anymore. Why I picked potato futures, I have no idea. I think that's probably what my broker said I should be trading. Maybe he said that there was an opportunity in potato futures, but anyway, I made money. And of course, just like most people who make money, their first trade or their second trade, it's about as easy as one could imagine, and therefore you think to yourself, oh my God, why didn't I learn about this a long time ago? That sounds kind of familiar, right? In terms of a thought process. And I went from trading potatoes to trading gold to trading silver. And I'd say my trading experience back then was probably typical, even to what it is today with most people, although you have to keep in mind that the technology that we had back then wasn't anything like what you have available to you right now today. It still boggles my mind when I think about the way we had to trade 25 years ago, or almost 30 years ago, compared to what's available right now. I mean, I've always been attracted more to trading commodities than stocks. As a matter of fact, I've never even traded stocks. I've always traded commodities and options. And I've never really had the desire to trade on the floor of the exchange. Although I lived in Chicago for 20 years, it never really appealed to me. I don't know how many people are familiar with the floor or the trading pits, but I just thought it was an extremely harsh environment, and not something that just, like I said, it appealed to me. But the kind of trading platforms that you guys have available to you today really, truly approximate what it would be like to have a seat at the Chicago Board of Trade or Chicago Mercantile Exchange and to trade at that level. You have instantaneous execution. And it's like you can change your mind and not feel humiliated or like, there's something wrong with you. You can put it in order. You can cancel it. Back, before the advent of electronic trading platforms, we used to have to call a broker. Now, you think about the time you made a decision to put on a trade. You think about the time that it takes, one, to dial the phone, for someone to pick the phone up, how many times it has to ring, and then he gets on the other end of the line. You got your broker, and then you give your broker your order, and then you've got to deal with the fact that, does your broker really approve of your order? In other words, what I mean by approve is that, well, say I want to buy 3 gold contracts, and say, well, some of my biggest customers, they just went short gold. Now what are you going to do with that information, okay? Or I've got, X number of guys that are on the other side of that trade. I say, well, yeah, if you want to take the other side of their trade, I mean, that's fine with me. I'll put the order in. So it's like, so he could put the order in, and then, you've got to wait for a fill. I can't tell you how many times that I put orders in the market where they were limit orders because they didn't want to do a market order because I didn't want to get the slippage of a market order. So you do a limit order, and on a limit order, the market has to trade. To be guaranteed to fill, the market has to trade through your price, does it not? How many times has the market traded to your price, okay, just right to your price on a buy order and reversed, and you didn't get filled? That's very possible. The problem when you're doing it with a broker over the phone is that order goes into the pit. It goes to an executing broker in the pit itself. So you've got a runner, and the order's got to go back to the runner, back to the phone bank, back to the broker, and the broker calls you with a fill. You're talking several minutes. Now, what if you're in a situation in a fast market where the market actually hit your price? You may have gotten filled, but you really don't know. You don't want to put a stop in the market because you don't even know if you're in or not. And the market's screaming, let's say, even in your favor, and you'd like to take profits, but you still haven't gotten your fill back yet. You don't even know if you're in the market. This is the kind of stuff we had to deal with all the time. All the time. It was a completely different world. Not only that, the only information that we had available to us was open, high, low, and close. That was it. Open, high, low, and close bars. And we used to have to get those unless we talked to our broker and pestered them, X number of times a day. You get it through the Wall Street Journal. We used to have to keep our own daily charts. Intraday stuff was just like non-existent. So anyway, I started trading like that. I went through. I don't even remember what my first trading account was. I think it was around $20,000. I lost all of that, and then, saved up some money and opened up another one for around 15, lost all of that, and then went to another broker, and I'm thinking this guy doesn't know what he's doing, and I'll find somebody who does. And then this is what really, this is probably the reason I'm even standing here today, was this particular trade, because this particular trade, it had a profound impact on me in terms of how it changed my life and what I was willing to do to find out what this was all about. To find out really what does it take to be a consistently successful trader? What does it take to really be able to earn an income as a trader. I was long silver. This would have been back in right around 1980 or 1981, or 1980, I think. I was long silver at around $9.75 an ounce. And there's two 5,000 ounce contracts at the COMEX. In other words, I was long 10,000 ounces of silver at $9.75 an ounce. And right after I got into the market dropped about 20 cents on me to about $9.55. So I was down $2,000. And my broker said, well, okay, you know, here's what we're going to do. Instead of getting out, we'll put you into a spread. And so what we'll do is you're long 10,000 ounces of silver in New York. We'll go short 10,000 ounces of silver in Chicago because you could trade Chicago silver at the Chicago Board of Trade. Everybody with me on this? Just want to make sure that you guys are all with, you know, even though I know many of you are stock traders, it's the concept is the same, okay? So I'm long 10,000 at 975. He puts me short 10,000 at 955 in Chicago. So I've got this spread going on. And then he said, well, when the market goes back in your favor, we'll just take the short leg of the spread off. Now, keep in mind, back then, you guys are. What do you typically pay for commissions, even in commodities, or even I don't know what you'd pay for stocks, but typically the average commission is about $4 to $5 a round turn, right? That's what you'd expect to pay. No, what are you paying? Less?
No, more.
More? Round turn? Oh, really?
I got the lowest.
Well, you're in the Dow. You're in the Dow Mini. What are you paying for the Dow Mini?
11.
11.
Well, that's as low as it started at like 30.
Oh, okay. Well, anyway, then 11.
Paying 89 back in the day.
Oh, okay. Well, back then, back in the 80s, we were. How much do you think we were paying back then? Come on, give me a guess. Come on, guess. What? Yeah, 125. How's 125 a round turn per contract? So in other words, for me to put this trade on cost me $250. Okay. When he put this one on right here, it cost me another $250. And then he said, of course, that when the market goes back into my favor, he'll take the short leg of the spread off, and you know I should be all right. So that's exactly what the market did. The market went back up to, you know, right around the 975 area. He took the short leg of the spread off, and then the market immediately dropped back down another 20 cents and put the short leg of the spread back on again. So that's another $250, okay? Plus, he just locked in, when he took this off, first of all, he locked in a $2,000 loss by putting this trade on. When the market went back up to 975 and he took this off, he locked in another $2,000 loss. And then when it went back down again, he put it back on and locked in another $2,000 loss. Now I'm down $6,750. Okay? And then, of course, it happened 2 or 3 more times. Now, from the market's perspective, all the markets, the silver market's just in a trading range. That's all it is. It's just in a trading range. But I didn't know how to read chart patterns at the time. I didn't really understand what was going on. I was just listening to him. And so what he was doing was just taking advantage of the fact that it was going back and forth between support and resistance and generating commissions for himself, okay? That was it. That's basically he was just turning my account. But that's not the story, okay? That's happened to a lot of people. Of course, it happens less now because we're all responsible for the trades that we put on. All we have to do is click the mouse button, and it's not that much money. But here's the story: is that as these losses are mounting, okay, and I can't sleep and getting real stressed out. You know, I wake up one morning and I thought, you know what, this is it. I just can't take this anymore. I just can't take it. And so, you know, when I got to work, I called them and I said, you know what, just get out of the whole damn thing. I just can't do this. So just liquidate the position. Does anybody remember the Hunt Brothers silver debacle? Oh, it didn't. Does anybody, if I say the word limit up, does anybody understand what I mean by that? Okay, the exchanges will impose artificial price limits of how much a commodity, or even a stock for that matter, can fluctuate in any given day before they stop trading. So we don't have these kinds of moves too much anymore. But back in the 80s, limit moves were really quite common. They really were. In other words, what would happen is this: is that if the market went up, let's say, I think in silver it was 50 cents. I don't remember exactly what it was, but if the market went up by 50 cents, they would actually stop trading. Meaning, if the market was bid up to, let's say, in this case, $10.25, trading would stop. In essence, what this means is that at 10.25. There were no people, there wasn't anybody in the world, there wasn't, this is important for later on. There wasn't one person in the world who was willing to sell silver at 10.25 if it was a limit move. Not one person. And so what happens is that the price will go up seeking to find who will actually sell. So what the exchanges didn't want is the exchanges didn't want there to be this huge fluctuation all in one day. There might have been sellers at 10.26, or there might have been sellers at $11, but you don't know that because the exchange says we're going to stop trading at 10.25. You guys with me on this? Okay? So what happened is that I don't think it happened more than maybe half an hour, 45 minutes after I got out. The market was trading right around $9.75 an ounce, where silver went limit up. And went limit up, was 30 days in a row to $49 an ounce. To $49 an ounce. I was looking now. Think about this. Okay, now think about being in this kind of a winning trade. Now, when we're in a winning trade, the market almost never goes straight up and it never goes straight down. There are rare occasions, of course, like in this case, when it does. So that when we're in a winning trade, we have to constantly be making decisions about where we're going to take profits. And how much heat we can take with the market coming back against our position to say, well, is this a time to take profits? Or am I going to let it come back a little bit further? Am I going to come back a little bit further against me? Because, well, is this normal retracement or is this more significant, okay? Is this a little bit of a profit-taking retracement? Is it more significant? Should I get out now? Do we have more left? Are we going to make new highs? You got to be making all these kinds of decisions. And it's very difficult, as we all know, right? See, in this case, I didn't have to be making any decisions because the market went limit up 30 days in a row. Boom, boom. It was like, go ahead.
Were you out or were you still?
I was out. I just got out like a half an hour before it happened.
So you were just going, oh my God.
Oh, yeah. See, the problem is I couldn't even get back in because there wasn't anybody willing to take the other side of the buy orders. On a limit move, you can't get back in. So I sat back and watched in complete agony. I mean intense agony. I didn't throw up, but it's like maybe I almost did. I don't know. Go ahead.
Why didn't you get out? You said you had 5 contracts?
No, 2. Just
Why
2.
didn't you just take one off the table, let the other one run for another day?
First of all, Jerry, you're assuming that I knew that this was going to happen.
No, I'm assuming that getting out all at once takes you out of the play completely.
Jerry, have you ever been in a situation where we really lost a ton of money and you just can't deal with it anymore?
Yeah.
I've been
in a situation where I've been down a lot of money.
Okay.
I didn't lose because that's on paper.
No, well, commodities, no. With stocks, you're right. With stocks, it's technically on paper. When you're in commodities, the money's out of your account. It's gone. It's gone at the end of the day. Okay, this is not paper money. This is real money. Are you with me on this?
Yeah, I'm understanding you.
Okay, so I wasn't looking at like I said, paper losses. The money was out of my account, so I'd had enough. I couldn't take it anymore. So when you think about it in that context, when you just made up your mind that I just can't deal with this anymore, it doesn't even occur to you to get out in stages. Why would I get out in stages when I've already gone through a week and a half of this back and forth and and it's virtually wiped out my account? Because by then I probably would have had to put more money, even for me to take just one contract off and leave one on, I probably would have had to put more money in the account. And there just wasn't any point in doing that. Are you with me on this?
I don't trade commodities. I trade other things.
But the concept's the same.
except it doesn't come out of my. It's as you said, it's a paper trade.
Yeah, you already own. You own stock. You own an asset.
I don't know.
And if you want to hold on to that asset until it goes down to zero, that's fine. Okay, your money is not flowing. In a sense, money's flowing out of your account, but not in the same way it is with a commodity.
No. Yeah.
Okay, I have to pay that money right now. You're just losing the value of an asset. I actually have to pay that money, and it comes out every single day. Go ahead. Go ahead and hand the microphone back to that gentleman.
Another thing that can be of interest here is, at least from the way I gathered you was talking a while ago, you really weren't controlling this. Your broker was doing this.
Correct.
So even if you had wanted to get out in stages, your broker was doing it, saying, hey, here's what I'm doing to you in this case.
Yeah, pretty much. Yeah, it's like I wasn't really in control of the situation because I didn't know what I was doing. All I know is that I was within, let's say, a half an hour, 45 minutes of a monster trade. A monster trade. Yeah, got it. And like I said, I sat back and watched in agony as the market went up to $49 an ounce. I'm thinking to myself, I was like that close to $400,000 on just 2 contracts. $400,000. And so, like I said, when I first started telling you this really had a profound impact on me. It really did. And I thought to myself, and at the time, I was managing a commercial casualty insurance agency in the suburbs of Detroit. Not really, I thought that's what I wanted to do. I didn't really know what I wanted to do, but, I aspired to management. I was very successful. And, at the time, even back then in the late 70s, early 80s, was making a 6-figure income, and I was only in my early 30s. So, I really had a lot of things going for me. But, after this experience, I thought to myself, I got to figure out what's going on here. And I certainly wasn't going to be able to do it in Michigan. So I thought, you know what? I'm going to Chicago. And that's what I did. I went to Chicago. I just thought, if I'm going to get into the business, who am I going to get into the business with? Well, back then there was Merrill Lynch, there's Dean Witter, Smith Barney, and I thought, who are you going to pick? You pick Merrill Lynch, right? Okay, so I went over to the Chicago Board of Trade. They have an office right there, and right on the second floor of the Chicago Board of Trade. And they just so happened they had 3 openings for trainee brokers, and they had over 1,000 people applying for it. So how am I gonna be one of those 3 people? I thought, well, you know what? I went back home. I went to one of the bigger Merrill Lynch offices in the Detroit area, and I went through the whole employment process to familiarize myself with what it is that they required to get a job. And this is what I think got me that job at the Board of Trade, is that they had an aptitude test, and there's a multi-page application, but on the back of the application they had a square like this, And they wanted spontaneously, while you're filling this application out, spontaneously what they wanted you to do was to write like a little mini essay about some philosophical question. Before I went to the Board of Trade and actually filled out that application, I spent 2 weeks agonizing over every word, just to make sure every word of that 2 or 3 paragraphs that I wrote down was completely perfect. So that when I took the app, I wrote down exactly what I'd worked on. And I can imagine why they hired me, because if he thought that I wrote that spontaneously in the moment, but hey, this guy, we got to have this guy here. We got to have this guy. Okay, so I did. I got the job. Now, think about this. Now, when I was working for the agency, the casualty agency, commercial casualty insurance, as a matter of fact, I just signed a contract not more than like 3 or 4 months before I actually went to work in Chicago, over a 3-year period for $360,000. And what Merrill Lynch was offering me was $20,000 on a draw. Okay, in other words, it was a, they're going to give me $20,000, but it's a draw. I mean, I got to pay it back based on commissions. Now, if you can imagine, there wasn't one person in my life, not one person, who thought that I wasn't absolutely stark raving out of my mind to give that up, to go to Chicago to do this. So, it wasn't like I had a lot of support. And it wasn't like I wasn't catching a lot of grief from everybody that I knew about what it was that I was doing. So you can imagine my horror, is a good word for it. I mean, because when I got to Chicago, I'm thinking, why am I even doing this? I'm doing this because I'm going to Chicago because that's where the traders are. That's where the people are who know what they're doing. Correct? And then to get there to find out that that is not the case. That is not the case at all. That there were 40, almost 50 brokers in the office, and none of them knew how to trade. Not only did they not know how to trade, I mean, Merrill Lynch made absolutely no bones about the fact that we were not traders. They spent no money, no time, and completely discouraged us from even learning how to trade. We were salesmen. We were taught how to talk about trading. We were taught how to talk about investments. We were taught how to, it's called dialing for dollars, to get on the phone and get people to open up accounts. And even though this was unspoken, I'd say the underlying philosophy behind the business was, especially in the commodities business, I'm not talking about the equities. I'm not saying that on the equity side of the business that it wasn't more reputable, but this was about as irreputable as it could be. Because the underlying philosophy that we operated from was, all commodity traders are terminal, meaning like they have a terminal illness. It's only a matter of time before they want to say, all commodity traders are terminal, and it is our job as a broker to make them as comfortable as possible until they expire. In other words, to extract as much money out of their account as you could until they're gone. And even to this day, it just blows me away to think that when I went to a 30-day training class in Manhattan, and there were brokers from all over the world, probably about 80 or 90 of us. And the guy and the person that was the head of Merrill Lynch Commodities at the time, his name was John Conheeney. And when he came in to address our class, and to this day, I don't know why he did this, but he said hi, and he started out with these words: the average Merrill Lynch customer loses all their money in 6 months. And that was the truth. Commodities, not equities, commodities. And that was the truth. That was about what it was. It took about 6 months for people to lose their account, and you just, like I said, you just go to the next one. So here I left this six-figure income to go to Chicago to learn about this business and this industry, and here I'm in a situation, and it's like, it was, like I said, it was appalling, absolutely appalling. So I thought, well, okay, I'll make friends with people on the floor. They must know what they're doing. The floor traders know what they're doing. Well, I found out that wasn't necessarily the case either. Now, it doesn't mean that the floor traders didn't know how to make money. But and I'm not going to get into this because we don't have time. But even though what you do is called trading, and what they do, they call trading, the way and the mindset that you have to make money couldn't be further apart, even though they're both called trading. The typical local, the person who traded for their own account in the pit or on the floor of the exchange, the way they made money, weren't trying to make direction-related decisions. In other words, it wasn't the kind of trading where they would find themselves in winning trades that were going in their favor, but that's not the reason why they put the trade on. And like I said, I'm not going to get into the specifics or dynamics of it because it'd take me too long to explain, and it just isn't necessary for right now. All I'm saying is that it's a completely, as a matter of fact, before I left Chicago and moved to Arizona, the Chicago Mercantile Exchange asked me, and I worked on it for a while, for about 6 months before I left, asked me to put together a program to help floor traders make the transition from the floor to screen-based trading, because it's a huge psychological leap. It really is. It's a huge transition that has to be made. So what I'm saying is that, not knowing that before I got to Chicago, it was like, here I'm in a situation where I really didn't know anybody who really knew how to trade, or at least knew how to trade in the sense of creating that consistency that we're looking for. It doesn't mean that people couldn't make money. People were making money all the time. It's just that, what's the point of making money if you're susceptible to giving it all back? In other words, if this is your equity curve, and then all of a sudden you're experiencing these huge losses and huge drawdowns, not only is this certainly damaging financially, but it's also damaging emotionally. And it can be very difficult to recover from. These are what I call the boom and busters. Okay, you basically had traders that fall into three categories as far as equity curve is concerned. You've got your consistent winners, the people who have the traders you've got your consistent winners. Now it doesn't mean that there aren't drawdowns here, okay? But what do you think these drawdowns would be a reflection of for the consistent winners? Consistent winners take losing trades all the time. But their drawdowns are a reflection of what? Anybody got any ideas?
Good money management skills.
Yeah, money management skills. Capital preservation. Okay, these are two good answers, but not the answer I'm looking for. Their drawdowns are simply a reflection of the normal losses that any trading methodology will incur. There is such a thing as normal losses. You don't have to write this down because we're just starting to scratch the surface. We are going to go into this in far more detail later on. So, I mean, if you guys want to write it down, that's fine, but it really isn't necessary. Okay? Normal losses that any trading methodology will incur. Then you've got people who learn something about how to trade, who acquire a good methodology where it is possible, based on that methodology, to experience a consistent income, but your equity curve might look more like this. Most people who are experienced the boom and bust cycles, these are the bust cycles, would say that something happened in the market to cause this. What you're going to find out today is that it is not the case. Even though it may seem like it, it is not the case. These are virtually always the result of trading errors, what I call trading errors, which we're going to go into in detail later on. One of the, just for the gentleman, few people back here that don't have any idea of my background, I'm going to go a little bit further in it, and I'm just going to jump ahead for a second. I ended up being a trading coach, and working with. I was a trading coach for probably about 17 years. I don't really do it much anymore. I just pretty much focus on my own trading, but while I was, especially in the, throughout the 80s and most of the 90s, I worked with a lot of floor traders. And we talk about boom and bust. There was one of the floor traders I worked with was probably one of the 5 biggest bond traders at the Chicago Board of Trade. And when I met him was in around May of 1992. And from January of 92 until the time that I met him in May of 1992, he had around, this is a guy that just traded for himself. He didn't trade for a firm. He just traded his own account on the floor of the Chicago Board of Trade in the bond pit. He had $12 million roll in and out of his account. And he had a particularly bad day, and he ran into somebody who attended one of my workshops and said, hey, you should go see this guy. He called me. We had a few appointments, didn't really go anywhere. And the next thing, about a month later, I get a frantic call from his wife, who I hadn't even met, didn't even know who she was. Got a frantic call from his wife that said, they're going to lose their house if I don't do something with him, okay? he had another real bad day. So anyway, I started working with him in July of 1992. And from July of 1992 until the end of the year, he ended up the year with almost $6 million. Now, that may not seem like a lot considering he had these swings, but he'd never finished a year with more than, I think, around $650,000 or $700,000. So he had just under $6 million. And so then he went on vacation. He happened to take a book with him called The Coming Collapse of the Bond Market. And this would have been in late December of 1992, early January of 93. and came back. Now, if anybody remembers the bond market back then, it rallied to spectacular heights. But in the meantime, he'd read this coming collapse of the bond market, so he was going into the market every day short, okay? And pissing away this $6 million until he got to the point where he had about 2 of it left. And took him about, I don't know, until maybe mid-February. And he was so exasperated that he said, hey, you know what? I'm willing to do anything. Okay, now keep in mind, I'm willing to do anything. And it wasn't lip service. It was real. It was genuine. It was sincere. And I said, if you're willing to do anything, then here's what you have to do. What I've been working with him, what I noticed is that he was able to stay focused really for not more than about an hour a day. Now, this guy loved trading. I mean, he just loved being in the pit. He just loved every part of it. He just had the hardest time tearing himself away. But if he really wanted to make consistent money, then I felt that an hour a day was about it. Because after an hour a day, he'd start losing, his focus would start to diminish, and then he'd also start to get reckless. He was the kind of guy, and this here again, this is very difficult for people to comprehend, but it is the absolute truth. He was the kind of guy where when I was working with him during that period, in the second half of 1992, where he would have a $500,000 day winnings. He'd make $500,000, but when he called after he was out of the pit to have his consultation, he'd be real angry with himself because he, up to about 5 minutes before the close, he was up $500,000, and then he'd piss away about 175 of it. So it only ended up with $325,000 for the day. Now, this is just like a normal guy like us here in this room with $325,000. And this was not an abnormal day, but he's real angry with himself because he pissed away that 175. And then the next day, he'd do about the same thing. He'd make 400 and piss away maybe 2 at the close. And then the next day he'd make, 350 and then piss away another 150. He's got spectacular wins up until Friday. But this accumulated anger that he was building up throughout the week, Monday, Tuesday, Wednesday, Thursday, by the time Friday rolled around, he'd lose $1.5 million. And then start the cycle all over again. So now it's like I'm saying, you know what? Especially as a floor trader. As a floor trader, you really have to be focused. When you're trading at the level that he traded at, where you're trading hundreds of sometimes thousands of contracts, if anybody knows anything about the bond market, we know that one incremental price change in a bond contract is $31.25, okay? You guys with me on this? So this would be a tick. So in other words, if the bonds went one tick up and you're long one contract, you'd make $31.25. If it went down one tick and you were long one contract, you just lost $31.25. He would trade 1,000 contracts at a time. That means one incremental tick price change was $31,000. $31,250. Now, if anybody's ever watched the bonds move, you know that it can move 5, 10, 15 ticks like that. Not only that, there can be what's called price vacuums. Everybody familiar with a price vacuum? You know what I mean by price vacuum? It means that if the bonds are at let's say 106.10. You guys are probably not familiar with bond prices. 106.10, that was the last posted price. That something can happen and you're long. Something can happen where there are no more offers and the next posted price is 106 even. That means the market went down 10 ticks without there being any trades between 10 and even. No trades at all. Which means if you're long, you just lost in that instant $31,000.25 on 1,000 contracts. This is quite common. So you really have to be focused. It would be like when you're trading at this level, I would make an analogy. It's almost like there's a couple of analogies. One, it's like if you're in an NBA playoff. It's the finals. It's the last game, 7 games. It's 7-game NBA finals. 1 minute left. The score is tied. The coach is going to send somebody in who's really focused. If the coach thinks you're distracted and you're not on your game, you think you're going to get in that game? This is the way to be in these kind of circumstances in the pit. That's the kind of mindset that you had to maintain. Because even if you were distracted and turned away, there could be bids and offers that would have gotten you out of your trade that all of a sudden dry up. Meaning when guys are bidding and offering in the pit, they're using hand signals and they're telling you they want to buy or they want to sell and how many. And there's hundreds of guys all around screaming. Now, these bids and offers can dry up because when you make eye contact and you point, you say, okay, we've got a trade, and then you write your trade down on your trading card, or now it's an electronic handheld device. But otherwise, you make a trade, and then you could be out of your trade and take your profits. When these kind of things happen, these price vacuums, you could be in bad shape. And just be a matter of just a momentary look away. The guy that you were going to use to get out of your trade is gone now. He put his hands down. Uh-oh, I'm in trouble. Well, what I found is that he could maintain an ideal mindset for about an hour a day. And so that's what I said. If you're really sincere, if you really want to do anything, you can only trade an hour a day. And he agreed to it. And he said, what hour a day? I said, it really won't matter. And it really didn't. He was convinced initially that what hour he went in would make a big difference. It really didn't make any difference at all. He was so good. As a matter of fact, there were other bond traders that I work with that said that watching him trade would have been the equivalent of like watching Michael Jordan play basketball. He was that good. And so he did. He went in just 1 hour a day. And because he knew that he only had that 1 hour, he was really focused, and he was averaging $175,000 for that one day, or for that on an average for that 1 hour per day. Okay, but that would be an example. He would be an example of an extreme boom and buster. Everybody kind of have that concept down in their brain about boom and busters, okay? And then what you have is the consistent losers, people whose equity curve looks like that. Now, just to get back to my situation, when I went to Chicago, I'm thinking, okay, I've got quite a bit of money. I sold my interest in the agency, but at the same time, I had a pretty expensive lifestyle, as you can quite imagine. I had a house in Michigan that. I had a girlfriend, a very high-maintenance girlfriend, and her 2 daughters were living in. And I had a very expensive apartment in Chicago and a Porsche, and I had the life, okay? And I was going back and forth every weekend to visit them. So really, my situation was, I couldn't maintain that kind of lifestyle with the money that I had without being successful as a trader. And that was the whole idea anyway. I thought, okay, I'll make whatever shortfall that, I end up with as a trader. And interestingly enough, I had to have my trading account with another brokerage firm secretly. I couldn't trade through Merrill Lynch. And there wasn't anybody else in the office who traded their own money. I was the only, unless they were doing it secretly and didn't tell me. I was the only person in the office who was actually trading their own money. Who actually traded, period, other than putting on trades for their customers. So what ended up happening is that, and another part of this is that I also had this, I can't really tell you why I knew this, it's just that I did. It just made sense to me. It just never occurred to me that trading was anything other than about psychology. I mean, the first trading book I ever bought was actually the very first book on trading. The first book that was devoted specifically trading psychology, which was Jake Bernstein's Investor's Quotient that came out in 1980. And there weren't that many trading books even available back then. And that was the first trading book that I didn't buy a book on technical analysis. I bought a book on trading psychology. So I was not only immersed in the concepts of trading psychology virtually right from the very beginning, I was also keeping very extensive journals of my thinking process, what was going on, what I was observing from other brokers in the Merrill Lynch office, as well as what I was observing from interacting with my customers. And I noticed we were all kind of conforming to the same patterns, the same problems. But just say that because I did have this kind of foundation, to understand that it was basically psychological in nature. Because one of the things we're going to talk about, when I get into the skills section of the presentation, is that when you look at trading skills, it's like, well, what kind of skills are we talking about? If we're talking about thinking like a professional, we're implying that the skills are all mental in nature, and they are. Because when you really get right down to it and you really start to think about it, what physical skills are necessary to trade? We're not talking about a golf swing or a tennis racket or any other kind of physical endeavor that we're familiar with. What kind of skills what does it take physically to put on a trade? A mouse click, that's it. Your ability to move the mouse and click it on the buy or sell button. It's that simple. And as a result of it being that simple, it's easy to think that, oh my God, trading is so easy. It isn't. As you well probably know, whether you've been at it a long time or even a little bit of time. There are some very sophisticated psychological skills that you have to acquire to get this kind of an equity curve. And virtually all these skills are founded in learning how to trade without fear. That's basically what this whole workshop's about, is learning how to trade without fear. Because that's what's going to screw you up on virtually everything. Everything that you can do wrong as a trader is going to be the result of what you're afraid of and the effects that fear has on your perception of market information. So with my situation, it's like here I'd given all this up to go to Chicago to learn how to trade, to find out that the only people who really knew how to trade back then were people that I didn't have access to. Meaning there were some big names in the industry who never really took the time or expended the effort to find out exactly what it is that allowed them to create a consistently rising equity curve. What they would say is, well, yeah, you got to go with the flow. The trend is your friend. Cut your losses, let your profits run. There's all these neat little phrases, but it's like, who in the hell knew what that meant and how to do it? Yeah, it sounds great. Cut your losses, let your profits run. Oh, even cutting your losses can be extremely difficult to learn. Letting your profits run can be 10 times more difficult than learning how to cut your losses. In fact, it's one of the most difficult things to acquire in terms of a skill is learning how to let your profits run. So it was like all this was kind of building up, and my lifestyle was draining my money away. And one of the things that I would say characterized me back then, if I was probably obsessive about anything, it was my credit. It's like my credit was as far as I was concerned, it was like the most important thing in life is to have flawless credit. Not just, flawless. And here I'm in a situation where I am truly running out of money. And my trading losses, it wasn't really like I was losing a lot of money trading because I'd really stopped the hemorrhaging. I wasn't trading in a way where I was actually losing money, but I wasn't making any money. And it's like there was always this little voice in the back of my brain, it would come to the forefront of my consciousness that would say, Mark, this ain't adding up. There's something wrong here. There's something wrong. It's like it's not adding up. And then I kind of shove it back there and, it's going to be all right. I'll figure it out. It's going to be all right. Eventually it got to the point where I was literally out of money. And the only choice I had was to file bankruptcy. Fortunately, I was in a situation where I had two residences, one in Chicago and one in Michigan. And so I had a choice of where I filed. And of course, I filed in Michigan because if Merrill Lynch would have found out, they probably would have fired me. As a matter of fact, nobody knew what had happened. Nobody knew in Chicago. Nobody that I knew in Chicago knew what had happened. So I filed in Michigan, and I'm thinking, literally, because of my attitudes about credit, I'm thinking, if I've got to do this, I'm going to fall beneath the cracks of society and never reemerge. I really believe that. I honestly, God, really did. I just didn't see how it's possible to live after having to do something like that. And of course, what I found is that, and when I ended up, what I say in the Disciplined Trader, and I don't really go into a lot of detail in the Disciplined Trader about this, but just to say that what I ended up with was really, I had an apartment, I had my bed and my TV, and when I filed, I was still current on everything. I wasn't even late one day on any of my bills. As a matter of fact, I even called the finance company to come and pick the car up. But I wasn't even late a payment. I said, you know what, I can't do it anymore. You're probably going to want it back anyway. So, it was like, come and pick it up. And of course they did. And you guys, there's a funny story about that. I never told anybody this, but you guys want to hear a funny story about that? When the guy came to pick it up. And so I'm thinking, because we're in front of the apartment building, and I'm thinking, well, if he's going to pick this up, then I ought to get some sort of receipt that it was in perfect condition, because I don't know what the hell he's going to do to it on I don't know. So it's like, and the guy wouldn't give me a receipt saying that, and so I wouldn't give him the keys, and so so he called his boss, and I heard his boss on the other end of the line screaming at him, "You do whatever he wants to get those keys," It's like, and he said something else I'm not going to say for this particular presentation, but yeah, it was like, they just someone's willing to give you the car, they don't even have to go repossess it. It's like, hey, give them the receipt. But in any case, what I realized, now you think about this, it's like when you define yourself based on your possessions. Just like anybody that loses anything, you've got an internal representation and you've got an external representation. And now there was a discrepancy between what was outside of me and what was inside of me in terms of the way that I define myself. And, so that has to be reconciled. And what I realized, and it didn't even really take that long. I don't remember how long it took, but it was like, one, I still had my job at Merrill Lynch. And so as a result, it's like I'm starting thinking, okay, well, things are going to be all right. I was in my worst fear. That was my worst fear. When the fear would creep up into the forefront of my mind, I was like, that was my worst fear. Now I'm in it, and I'm realizing that, I think I'm going to be all right. I'm healthy. I can still think. I'm going to be all right. And when I came to this realization that I'm going to be all right, this is when things change for me as a trader. And this is the interesting part about my situation that most people don't have the benefit of experiencing. There are two things. One, I had this foundation of knowing that it was all psychological anyway. So I had all these things that I'd been working on up to that point. And two, when you tap out as a trader, when you really tap out, you don't get to trade anymore because you don't have any money, right? But I was in a situation where I still got to trade. Even though I was working with other people's money, I still got to trade every day. And so as a result of experiencing my worst fears, coming to the realization that I'm going to be all right, and then at the same time being in a position where I'm able to interact with the market, it was like, because I didn't have anything more to lose, I didn't. It was like was like this, the market completely changed for me. It was like I had these blinders on that all of a sudden just came off because the market was different, because I wasn't afraid anymore. I was seeing the same patterns over and over and over again beforehand, but I was seeing the same patterns differently. I was seeing the same patterns from a, let's say, relatively carefree state of mind. And that relatively carefree state of mind allowed me to, like, say, flow in and out of my trades with an ease and effortlessness that I would not have been able to imagine beforehand. And then what happened is that I started making consistent money for my customers. And there's even, well, there's one really, as a matter of one really good story where, I mean, there are a lot of good stories that I can tell you about my customers at Merrill Lynch. But in one case, I inherited this guy who at the time was the head of the state of Illinois' mainframe computers, and he was from India. And he had put together his own trading program, and he was using the state computers to do it. And so, and he had an account, technically an account with Merrill Lynch, but wasn't funded because he'd lost all his money. But he still maintained the account. And so I inherited him as a customer, and he would call me every day. And he was just like, and all he would say to me is like, I'd pick up the phone. He wouldn't say, hi, how are you? He'd say, give me data. Like, give me the high, low, and close. And, so we interacted like this for a long time. Well, he came up with his own day trading system that eventually, well, because he and I started working on it together. He had the internal program for it, but he didn't have any money management parameters for it. So after about 2 or 3 months of working with him on it, we came up with some really good money management parameters. And then all my customers started trading it, and we were making consistent money day after day, even to the point where Merrill Lynch was starting to take notice. Here all this whole customer, his customer base is making money, and he got to the point where he's thinking, okay, all these people are now deriving this benefit from my work. I should be able to do it too. And he talked his wife into letting him put $5,000 into his account to fund his account. Now, I didn't know what happened to him. Why? I mean, it's not like we had personal discussions, so I don't know why he didn't have any money in his account. The guy was a maniac. It's like he put the money in his account, and 2 days later it was all gone. It was like he'd call me up and say, okay, do this. I said, well, wait a second. The system says to do this. He said, no. I don't care what the system says. This is what's going to happen. He didn't follow any of his own rules. Now here we had a track record. We had a legitimate track record, bona fide, real money. Day after day. He gets a few bucks in his account, and it's like he thinks he knows where the market's going. Like I said, he was gone in 2 days, and that was it. It was all over with, because at that point, he was done. I didn't get the system because it was in his mainframe computer at the state of Illinois, and had no more contact with him. And shortly after that, ended up getting fired from Merrill Lynch anyway, because there was one of these management consultants that came in from New York, and she was going around the office talking to all the different brokers because of whatever it was that they were trying to find out. And she got to me, and by that time I was already writing The Disciplined Trader. And I just I started very exciting to say, oh yeah, this is what I found out, and this is what I've learned. And her eyes lit up saying, this is exactly what we're looking for. And she was we talked for probably about an hour and a half, and she was all excited. And then she said, I got to go tell, well, I'm not going to say his name, the office manager, okay? And she walked away from me, walked over to the office manager. 10 minutes later, he came over and said, pack up your stuff and get out. Right then and there on the spot. Pack up your stuff and get out. So that's how I ended up actually being a trading coach, because by then, floor trade, because I'd made friends with floor traders. I was making friends to find out how they trade and that sort of thing. Well, they started coming to me for advice, even while I was at Merrill Lynch. And because it's a pretty small community, you know, the word gets around, especially when you know, people are really genuinely helped with the kind of advice that you're giving them. And I'd help several floor traders turn their trading around. And so what had happened is I started getting hired by clearing firms. What I mean by clearing firms is that to trade on the floor of an exchange, you have to clear your trades through a financial institution. And so, you know, it's like these are traders just like you. They have their own account, but what they have to do is they have to clear their trades through, like I said, one of the major clearing firms at the exchange. Well, what would happen is this, that it isn't like this now, but back in the early 80s, or the mid 80s, clearing firms were in some ways like almost like family operations, where the people who owned the clearing firms, they knew all the floor traders, they were friends with them, they partied together, you know, Christmases and holidays and that sort of thing. And so if one of the floor traders would go debit, you know what I mean by go debit? In other words, you know, you have to have a positive balance in your account. Well, the problem with floor trading is that not today, but back then, when you traded on the floor, you had to record your trades on a trading card. So in other words, if you and I are entering into a trade where I'm going long and you're going short, what I would do is that we would take our badge, like the acronym of our badge, and our clearinghouse number, record it on this card, and how many contracts we traded. Let's say you're short 10 and I'm long 10, and the price that we traded them at. Well, those cards didn't have to be turned in until the end of the day. And then they'd all get reconciled, meaning that between all the different trades and all the traders from all the different clearing firms, this would all go into a central clearing operation to find out which trades were, you know, to find out who's long and who's short, how much money's coming out of whose account, and whether or not they were called what are called out trades, meaning that you thought I said 10, and I thought we were doing it for 100. Okay, so now we've got a discrepancy of 90 trades. These were called out trades that had to be reconciled before the open of the next day, which is a whole nother world. We're not going to get into it. All I'm saying is that it would not be unusual for guys to overtrade during the day, and the clearing firm wouldn't even find out about it until the end of the day. For an example, one of the guys I worked with at Merrill Lynch, eventually he was a mathematics professor. He's a really nice guy. Should not have been a trader at all. Had absolutely, I mean. Anyway, with P's at the Chicago Mercantile Exchange, and he was a one-lot trader, meaning, you know, just traded one contract, one in and out, one contract, and eventually the forces inside of him were building up where he's frustrated with the fact that he can't make a living at it, he's just eking it out, where one day he snapped, and this one-lot trader almost took down the clearing firm. In other words, he's got like several thousand S&Ps on, several thousand contracts where other guys are into those trades and the market's going against them. So he almost took down a clearing firm just by himself. So what would happen is that because guys would go debit, meaning they end up the day lost, maybe they're down $25,000 or $50,000 or $100,000. The guy that owns the clearing firm doesn't want to say, hey, you can't trade until you pay this off. They'd want to let them to go back into the pit to work it down. Well, after, you know, you got 4 or 5 of these troublesome or 15 of these troublesome traders that are constantly running debits, you start to get a little worried. And so what they did is they hired me to work with these guys. Most of the information, most of the insight, let's say, that you'll find in the disciplined trader and trading in the zone came from me working with these floor traders on a daily basis. And I'm laughing because obviously it was quite a trip working with these guys, because they are not like you and me. that's really about the best way I can describe it without going into a lot of detail. They're not like you and me. So anyway, this is kind of maybe a long drawn out introduction to the fact that what we're talking about here is that you guys have a really wonderful trading methodology where there is an enormous amount of potential for you to be able to make a consistent income from being able to take full advantage of the potential that this trading methodology offers you. But I would say that it wouldn't be unfair for me to say it wouldn't be unfair for me to say that there's probably what I'm going to call the profit gap. The gap between the potential and your bottom line results. This is the potential, and this is your bottom line results. Most people think that when they realize that this gap exists, that somehow learning more about the markets is what's going to fill it. And what you're here today to learn is that that is categorically not the case. You have to learn more about yourself and how you interact with your trading platform and the market to be able to fill this gap. There are psychological skills involved. And then when I talk about psychological skills, do anybody think of an example of a psychological skill? This is difficult. I don't think, I'm not saying that you should have the answer, but can you think of an analogy in maybe in other parts of the way we express ourselves that you can think of what would be an example of a psychological skill?
Anger management.
Anger management? Okay, good. Anybody else? Okay. What about a situation, and anybody watch Wimbledon here lately? Just it was on? I'm not a big tennis fan, but I just happened to be watching it. And because I knew that I was doing this workshop here, this is something that really sticks in my mind. What's the difference between let's say, here, this is even a better example. What's the difference between a pro basketball player who can stand at the free throw line and hit 20 in a row, even 30 in a row, where the thing about the variables are fixed. The line and the basket and the distances, they're all fixed. And they've got the motor skills to be able to hit, like I said, 10, 15, 20 in a row. But they get into a situation where there's 1 second left and the score is tied and this basket is going to win the game and he chokes. That's a cycle. The guy that doesn't choke has a psychological skill that the other one doesn't. Trading without fear is a psychological skill. It is a skill that the professionals have acquired and they have evolved beyond the typical mindset or the kind of mindset that the typical trader operates out of. So when we're talking about trading or thinking like a pro, that's exactly what I'm saying. I'm saying that you will evolve beyond the typical mindset so that you can take full advantage. This represents, if this line represents potential, that you can take the potential of your methodology so that you can take full advantage of your methodology. Because it has to do with your state of mind. In this section, we're going to cover the underlying nature of the mental skills that you're going to be learning. And then at the end of the section, I'm going to put these skills within the context of 3 developmental modes that you're going to eventually learn to trade in, which would be first the mechanical mode, then the subjective mode, and then the intuitive. Everybody kind of have a good idea where we're going today? Maybe a little bit better of an idea than when you kind of walked in here? Yeah? Okay? So anyway, what I want to do is let's just go through and take a little bit of an attitude survey here, kind of get an idea where you're at. There are no right or wrong answers here. It's just a matter of what you believe about the nature of trading. So if we just kind of making money as a trader is primarily a function of analysis. Who would agree with that? Everyone, come raise your hands. It's all right. You raise your hands. So you're telling me that only a few people would agree? Part of it? Okay. Okay. I often find myself thinking there must be a way to trade without having to take a loss. Come on, be honest. Come on. Oh, yeah, let's say I find myself thinking that there must be a way to trade without taking a loss, right? Okay. Okay. By the way, the first one of the things, this is a primary. One of the things we're going to talk about a lot of making money as a trader is primarily a function of analysis. That really isn't the case at all, what you're going to learn. In other words, trading is execution. Trading is execution. What you decide to do, of course, is analysis. And the problem is that it depends on what you're using your analysis for. If you're using your analysis to avoid the risk, then certainly making money is not a function of that, because you will virtually consistently lose. But we're going to talk about that more in a little bit, okay? Okay. I have trouble getting out of a losing trade. Anybody here still have trouble getting out of a losing trade? Okay, that's fine. You won't have that trouble after today. I'm really, my goal is that when you walk out of here, you will understand in no uncertain terms that there was absolutely no reason to hang on to what you will define in advance as a losing trade. Do you find yourself planning trades you never execute and executing trades you never planned? That's a pretty common thing that affects most traders. There's always a cost associated with finding out what the market may do next. It's good to think that. That means you're accepting the risk. That there's a certain amount of, cost meaning a certain amount of risk involved in finding out what the market may do next. If I were to thoroughly analyze my trading results, I would find that my average losing trade is much bigger than my average winning trade. Well, a few people in here that might still be falling in that category. It only takes one trader somewhere in the world to negate the positive outcome of any particular trade. Who agrees with that? Anybody? Raise your hand if you agree with that, please. Nobody raises their hand. Oh, this is big. I love it. Thank you very much. Thank you very much for not agreeing with that, because you couldn't be further from the truth. You couldn't be more wrong. This is one of the things you're going to learn. It only takes one trader somewhere in the world to negate the positive outcome of your trade or your edge. That's all, just one. You're going to learn that today. I wouldn't put on a trade if I wasn't sure it was going to be a winner. Who agrees with that statement? Please raise your hand, please. Who agrees with that statement? Good, good, good. I'm saying good because what I'm saying is that, yes, there is a gap here that we're going to have to fill between your particular attitudes about trading now and where you're going to end up with, hopefully, by the end of the day. I would answer this question, absolutely not. I wouldn't put on this trade if I wasn't sure it was going to be a winner. I trade from the perspective of I don't know if any trade is going to be a winner. And I don't have to know. As a matter of fact, that is one of the principal, let's say, principal concepts that you will have to adapt to become a consistently successful trader. And what the pros have adapted, and the reason why they can do what they do, is because they have learned, not just learned, but they believe, without a shred of doubt, that they do not have to know what's going to happen next to make money. And don't even think about it in those terms. They don't even think about it in those terms. It's not a matter of what's going to happen next. When you understand the nature of how technical analysis, how your technical formulas and your mathematical formulas interact with market behavior and what they can and can't do and what their inherent limitations are, you will also understand that I wouldn't put on a trade if I wasn't sure it was going to be a winner is absolutely one of the worst mistakes you can make to be a consistently successful trader. It is. In fact, it's probably the number one. Kind of perplexing at this moment? Yes? Good. Okay, I always define my risk before I enter a trade. Is everybody here in this room at the point where they always predefine their risk? Who doesn't? Raise your hand. Please raise your hand. I want to know where everyone's at. Come on. It's all right. Okay. Sometimes I find myself blaming the market for what went wrong. Well, let me ask you this. Does anybody feel betrayed by the market ever? Anybody ever feel betrayed by their signal, their technical signal, or whatever methodology that they use? We're going to talk about that in detail too. The more a trader learns about the nature of the markets, the easier it will be for him to execute his trades. Who thinks there's a correlation there, that the more I learn about the nature of markets and price movement, the easier it will be to execute your trades? Who thinks there's a positive correlation there? Okay, again, couldn't be further from the truth. There's a negative correlation there. The more you learn, the harder it's going to be to execute your trades. It depends on why you're learning it, of course, but we'll get into that. To be a successful technical trader, you have to determine what the market is going to do next. I already said that's not the case, so you'll know how to answer that one. But if I hadn't said it, how would you have answered it? Who would have said yes if I hadn't have already told you guys? A couple people? And you came to Houston? Oh, come on. Oh, come on. Okay, trading skills. Who are the professionals? We already talked about that. And why would it be beneficial to think like a professional trader? We already talked about that. What's the answer? Anybody can make money, okay? We kind of already established the fact that anybody can make money as a trader. Yeah, we're talking about consistency. What we want to do is we want to close that profit gap. We want to make sure that our bottom line results reflect the potential of our methodologies. Okay? And that's what the professional has learned how to do. The professional has learned how to close that profit gap. They have learned the appropriate skills to do that. They're people just like you and me, okay? They're no different. They really aren't. They've evolved into a different way of thinking about trading. That's the reason why they can do it. And you can do it too, with understanding and awareness. That is really primarily what this workshop is about anyway. Because when you think about it, if you've read stories of people who have aspired to greatness as a trader, you'll always find, with almost all of them, that there's this underlying thread, this underlying theme that virtually all of them have lost one or more of what they considered a fortune before they started becoming consistently successful. Why do you think that underlying thread or theme exists in their lives? What's that? Why do you think that commonality exists? Because at some point they lose so often and then come back from losing that, one, they gain the confidence that they can do it, and as a result, the fear dissipates. And as soon as the fear is gone, they're trading from a carefree state of mind, and when you trade from that carefree state of mind, everything about your trading changes. Remember that the primary skill that we're talking about here is simply trading without fear. This is a trading skill. It is the primary skill that you will have to acquire to create consistency, to trade without fear. What does consistency look like? I've already went through on the grease board here and showed you a consistently rising equity curve with the drawdowns, the normal drawdowns being a reflection of what? Can anybody remember what I said about that? What was that? Normal losses that reflect any trading methodology, right? Okay, what skills are necessary to experience a winning trade? Now, think about it. Now, I'm going to contrast, okay? I'm going to do a little bit of contrasting here. Just to show you one of the reasons why it can be so difficult to get even into a frame of mind where we start asking the appropriate questions about what do I need to really be consistently successful? Because what does it really take to experience a winning trade? What skills do you need? Anybody got any idea? What skills do you need to experience a winning trade? What? What's your name, sir? Maurice says a click of the mouse. Who's with Maurice on that? Come on, who's with Maurice on a click of the mouse? Got 1, 2, anybody else? 3, 4. He's absolutely right. That's all it takes. There are no other skills needed. No other skills needed other than the actual physical ability to put your finger on the mouse button and click in the buy or the sell, and you can find yourself in a winning trade. You can find yourself in a spectacularly winning trade, far beyond what you could have ever imagined. And what skill did it take? What did it take? Just doing it. That's all. Just doing it at that moment. Do you need an edge? Do you even have to know what an edge is? Is it possible to just to walk up to your computer and the arrow happened to be on the buy button, you click and then find yourself in a winning trade? You didn't have an edge, did you? You just clicked it. What did it take? It took nothing. Do you need a plan? Need no plan. Do you need the discipline to execute the plan? No, you don't need that either, do you? Now, see, you're going to see the opposite of all this, of course, is what we're going to be talking about in terms of creating consistency. But go ahead.
What you're saying is a blind squirrel will eventually find a nut. Sorry. What you're saying is a blind squirrel will eventually find.
Did you say a squirrel? I'm sorry, squirrel. Okay, squirrel. Okay, go ahead.
Yeah, I can click a mouse. You know, the arrow hits the buy, I click, I get a great trade. That's good. It's all the things that lead up to me. That's the implementation. But what about all the things that lead up to that implementation?
Oh, I understand. I'm not negating that at all. I'm just saying that the reality is you don't need anything. That's all I'm saying, because I'm contrasting here. I'm just making a contrast between what you need to be consistent and what you need to win.
Oh, okay.
That's all I'm doing, okay?
You just summed that up with what I was about to say. There's all the difference in the world between having the skills necessary to experience a winning trade as compared to having the skills necessary to consistently experience a winning trade.
Absolutely. That's all I'm talking about here. Because see, because what this does is the not understanding this contrast creates what I call like a huge psychological gap. Because it's very easy for us to think that trading is easy. And if you believe that trading is easy, even if all your experience is starting to tell you that it's not, it doesn't mean that experience is dropping down to a level of realization where you change your behavior or change the way that you think about trading. If your first impression, if your first experience was that this couldn't be simpler. And then you spend, how many X number of years or half a lifetime finally coming to the realization that, you know what? Yeah, to win, like what do you need? Like I could be in a casino and plunk $100 bill down at a blackjack table and end up with a blackjack. What did I need? Nothing. I just happened to win. Now, if I want to be a professional blackjack player and make a consistent income from playing blackjack, well, that's a whole nother matter, isn't it? And we're talking about the same things here with trading. There'd be a number of skills that I'd have to acquire to be able to make a consistent, reliable income as a blackjack player. And there are people who do it. Do you need a good reason to put the trade on to win? Do you need a good reason? No, not at all. What characteristics distinguish the pro from the typical trader? Well, they plan their trades. No. They execute their plan without error. We'll talk about trading errors in a minute. Big difference. Okay, they can move in and out of their trades with an ease and effortlessness that would boggle the mind of the typical trader. Okay, what do you need to achieve consistent results? Well, you're gonna need an edge. You're gonna be able to identify an edge. You're gonna have a trading methodology, are you not? Right? Okay? And you have to have a plan on how to utilize that edge. In other words, you're gonna have to determine risk parameters. How much does it cost me to find out if this particular edge that my methodology provides me, how much is it gonna cost me to find out that this edge is working on this particular trade or not? That's your risk parameter. Are you guys with me on this? Okay. Money management parameters. In other words, how much in other words, contract size or number of shares that you trade. All this has to be taken into consideration. You could have a standard amount, or you could have an amount that fluctuates based on other criteria that you use, to determine, the level of trade that it is. Like it could be like a 5-star trade or a 1-star trade. With a 5-star trade, you go in with a maximum position. With a 1-star trade, you go in with a minimum position. And profit objectives. You have to be able to set profit objectives. See, just having a methodology to get you into a trade is not enough. You have to be able to determine what the risk is on a consistent basis. You have to know what your money management parameters are, and you have to be able to determine where to take profits. None of these are easy things to do, are they? Trade execution. The ability to execute trades flawlessly so you can utilize your trading plan to its maximum potential. This is the big one right here. This is the area, because when you get right down to it, trading is execution. The act of trading is executing trades. And if you're going to execute trades, you're going to have to be able to do them without errors, because it doesn't make any sense to think that you will achieve a consistently rising equity curve if you're constantly making trading errors. Trading errors would be defined as mistakes. mistakes that detract from your bottom line results. Now, the interesting thing about mistakes is that when you're trading from the, let's say, the perspective of, it doesn't really take anything to win, then there really aren't any mistakes that you can make, because anything that you do could result in a winning trade for any reason. But when we're talking about making consistent money or an income that we can rely on, then everything changes about this. Everything changes. What I'm talking about here is I'm talking about these like 5 or 4 broad skill sets to be able to create consistent results, the kind of results that you can rely on as an income. You're going to have to learn an edge. You're going to have to acquire a trading methodology that gives you an edge. I'm defining an edge as that there's a higher probability of one thing happening over another. That's what an edge is. And we're going to learn the nature of probabilities here in a moment. You're going to have to have, you're going to have to have a plan on how you utilize that edge, meaning what the risk is, position size, and profit objectives. Then you're going to have to be able to execute. You're going to have to get to the point where you can execute that edge without making errors. For you to be able to execute that edge without making errors, you're going to have to learn how to trade from a carefree state of mind, meaning you're going to have to aspire to the point where you can trade without fear. And to trade without fear, you're going to have to learn how to think in probabilities. That's basically where we're going here. When I said this primary skill was learning how to trade without fear, learning how to trade without fear is a function of learning how to think in probabilities. Meaning we're going to set aside or move from thinking in a trade-by-trade mentality. In other words, what this trade is going to do for me right now, am I right or wrong on this trade? And we're going to move to a series of trades perspective, because that's what your methodology does anyway. Any trading methodology just gives you a win or loss ratio over a percentage of trades. In other words, if I take the same criteria that's in any kind of mathematical, any kind of technical formula that's mathematically based, or a technical price pattern that you would be able to see visually, what we're going to learn is that my edge, meaning a higher probability of one thing happening over another, is simply going to give me a higher win rate over a series of trades. Let's say the next 20 trades. 1, 2, 3, 4, 5, 6, 7, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. And that the actual, on a trade-by-trade basis, I don't know which one's going to win or which one's going to lose in advance. There is no way for me to find out. There's no way for me to determine that. That on a trade-by-trade basis, no matter what reason or rationale that you come up with, is that there is no way to assure yourself that it's going to be a winning trade. There's nothing that can tell you that. That trading methodologies give you a win percentage, let's say 70% of the next 20 trades are going to be winners. There's no way I'm going to know which of the 70, which 12 or 13 are going to be the winners, or which 6 or 7 are going to be the losers. What you're going to learn, and this is what traders, the professionals have learned, is that there's a random distribution between wins and losses over any given set of criteria that define your edge. There's a random distribution. I will get a higher percentage of wins to losses, but I just don't know which trades are going to be. It requires a complete shift in the way you think about trading. When you make this complete shift, everything about your trading will change. Now, I'm expecting you to make it now because we're still in the introduction. We won't really get into the meat of this until a little bit, but this is where we're going, okay? That's all I want you to get. This is where we're going. You're going to genuinely learn how to think in probabilities. Because when you have genuinely integrated these concepts into your mental system at a functional level, your fear will go away. You do not need to lose everything to get to the point where you can figure out that, well, I've got nothing to lose anymore, so I don't have anything to be afraid of. You don't have to do that, okay? You don't have to do that. All you have to do is commit yourself to learn how to think about trading in another way, and your fear will go away. Because what we're going to learn is the correlation between what we believe and what we feel. There's a direct correlation between if I'm going into a situation with a certain belief that, let's say, that my particular edge is going to tell me what's going to happen on this trade right here, I wouldn't even put this trade on unless I thought it was going to win. When you really understand the nature of price movement, which is what we're going to get into after we go through this section on skills, when you really understand that, you will never think that way again. When you really understand the nature of price movement, you won't think that way again. And that is one of the biggest problems that the typical trader has. Let's say the typical screen-based trader is that they really don't understand the nature of how prices move and the underlying dynamics, because you haven't had the exposure. You haven't had the exposure to the direct markets. Your only exposure has been those blips on the screen. And as a result, there's a real gap in understanding about what's really happening. When you understand what's behind those blips, what's behind those photons that show up on your screen, when you really understand that, you will think about trading in another way, in a completely different way. It won't even occur to you to do some of the things that you're doing now. Won't even occur to you. Okay, now, I've given you 3 so far. The next broad area that you're going to have to learn is like you can be an expert at defining an edge. You can even be able to execute your trades flawlessly, but run into the next challenge, and that's what I just call self-sabotaging beliefs. In other words, all of us have a sense of self-valuation. All of us have this sense that what we're worth as a person, you might say. And if you were to take like an old Ben Franklin accounting scale, okay, and this is positive and this is negative, meaning if you were to list every experience in your life, if you had, let's say, conscious access to every experience in your life that contributed to a positive sense of self-valuation, that yes, I am a worthy person. Because what we're running into, I kind of got to get ahead of myself. What we're running into is this, is that when you learn how to define an edge and learn how to execute your trades flawlessly, what you're now exposed to is the possibilities for unlimited wealth. There's really nothing holding you back. Well, let's put it this way. There's nothing on the outside that's holding you back, but there might be something on the inside that's holding you back. Those things on the inside could be self-sabotaging beliefs. In the sense that if you listed all of the experiences that contributed to a positive sense of self-valuation and all experiences that contributed to a negative sense of self-valuation, that I'm not worthy as a person, I feel guilty about this, and this, that you could end up, you can go plus negative, or net positive or net negative. What could end up happening is that if you don't have the, let's say, the skills or the awareness to realize that as your equity curve, as you start making money, these internal forces, if you have net negative, these internal forces start building up to the point where they'll cause you to make unconscious trading errors, where you're not even really aware that you hit the sell button instead of the buy button. Those kinds of things. And you have to become aware of when these forces are starting to build up inside of you, and either compensate for it by not trading, to stop trading, or to find a way to neutralize them. And there are various techniques available. But all I'm saying is that these kinds of errors that are the result of self-sabotaging beliefs don't really have anything to do with your direct trading skills. In other words, your ability to identify an edge and your ability to execute your trade. But they can have an enormous impact on your equity curve.
I would assume that you would be monitoring your equity curve, and you would start seeing your curve go down in an abnormal way. And you would start looking for whatever's happening to you. Let's say you're not feeling well, or whatever. Your wife just divorced you. Or maybe
yes.
something.
Yeah, these
subtle.
are all good things, right?
Things
that you're bringing up. I mean, these are things that
What
are all
I'm
relevant.
saying is, though, you show two extremes, a normal drawdown, and then the boom or bust drawdown. There must be some way to know. At least I'm looking for to know when you start looking that you're self-sabotaging. That's my question.
Good question. As a matter of fact, there are software programs available now that will tell you that. There are software programs available that will tell you when, in other words, I'll give you an example. I'll give you an example. When I was working with traders, with especially like hedge funds managers and larger traders, there are people, first of all, there are people that their sole job was, if they were, let's say they were central, here, let me think about how important this is. They had, let's say they're in the middle, and they've got, let's say, 10 or 12 money managers. These are guys that all have, they're managing funds, okay? This guy's sole responsibility was to shift money from here to here to here to each manager based on chart patterns of their equity curves. In other words, they would chart the equity of these particular traders just like price patterns in the market to determine their potential for inordinately large drawdowns because of self-sabotaging beliefs. That's how sophisticated the market has become. That's how relevant these issues are. So that you can actually chart your equity, and then you start to go like this. Oh, well, and then do another one like that. Something's happening here, okay? I mean, it was really kind of amazing to me when I was working with floor traders especially. I mean, this one guy, this pops into my brain just as we're talking about this. I mean, he came in for a consultation, and he had his worst day in his life ever. Worst trading day, lost more money than what he's ever lost in his life. And I said, well, and it's like normally, almost virtually, in every case, something catastrophic's happening in that person's life. But what was always amazing to me is how much of a disconnect that the person would have between the catastrophic event in their life and what they ended up doing as a trader in the market. And I said, well, what's going on? And I just said, well, what's going on? And he's kind of, well, yeah, my wife and I had this really bad argument last night, and when I left for the exchange this morning, he slapped his kids around and he kicked his dog, and it's like, and then he came in and had his worst day and didn't make the connection between what happened at home and what he did on the floor. I mean, he might have felt completely justified with the argument that he had with his wife in slapping his kid around and kicking the dog, but that's what's going on consciously. But let's say subconsciously, everyone has, let's say if a person's relatively normal, not a psychopath, they've got some sense of fairness, and he feels guilty about what he did, and he took that guilt out in the way he traded that day. The market is not a good arena to be doing this, by the way. Okay, this is not a good area to be working these kind of emotional issues out. Go ahead. We need the microphone. You want me to put it right here, and I'll just hand it to him?
My next question would be the market also changes. The patterns or your edge may change in relation to the market. To distinguish between your own troubled state, let's say, and market behavior, I can see that maybe one of these fellows here in the pie there might be using a system that is not as valid as it used to be when the market changes. How would you know, if you were the guy in the center, whether he was just having a bad stay with whatever's going on in his personal life versus a change in his system in relation to the market?
Another good question. You wouldn't know immediately, but upon investigation you could find out. In other words, by just talking to the guy, or what you do is that see what you do is you trade in sample sizes too. In other words, when you have a particular methodology that has a defined criteria for when you get into a trade, what you do is you trade in a limited sample size, so that if you trade in 25 trade sample sizes, or like 20 or whatever, what you do is you analyze your results at the end of a sample size, and if your results are satisfying, then what you do is you take another sample size. If the results are not satisfying, then because you knew exactly what you did and under what circumstances you did it, you limited your variables. What you do is then you can go back and tweak your variables to see if you can improve your results. Because what's your name? Tom. Because what Tom was really bringing up is the fact that you're right, because we're taking a limited set of variables, like mathematical formula, that's being applied to a dynamic event, and that dynamic event are traders who are acting on their own behalf, creating price movement, and they create patterns that were doing the same thing over and over again, but you've got new people coming in with new ideas and old people leaving, and as a result, these patterns can change over time, diminishing the results of a particular edge. So what you want to do is you want to make sure that your sample size is large enough to adequately test that edge, but small enough so that if the edge is diminishing in its effectiveness, you're not losing an inordinate amount of money before you find that out. Does that answer your question? So that's how they find out, okay? Besides that, there's software available that'll even tell you now. There's software available that'll track your edges, or to track your equity in a way that can indicate whether or not you're ready to take a hit. I don't know the name of it, but because I just found out about it myself. So,
what are some other ways that you can address maybe a emotional problem you might be going through, or other things outside of the trading area besides stop trading?
Well, you say there are a number of techniques, a number of books available. There's counseling. I'm going to make a recommendation of a particular book later on, when we get into a little bit more detail, but it depends on the effect that it has on your trading. I mean, you don't necessarily have to stop trading, but you have to make an objective assessment as to your state of mind. In other words, you can actually say to yourself, am I in the best state of mind to be trading today? And, and the kind of answer that you get back from yourself, if it's relatively objective, it's like if you're really not in the best state of mind because of things that are going on in your life and some troubling aspects that you haven't reconciled, but you don't want to stop trading, well, at least you're aware of it. Another technique would be by keeping journals, because most really good traders keep pretty extensive journals about what they're doing and what they're thinking while they're doing it. And then you make this assessment so that at least if you don't want to stop trading, you still want to put whatever edges on you have for that day, you scale back. In other words, if your maximum position size is, let's say, 5,000 shares, you're not in the best state of mind. Maybe you only want to trade 1,000. Maybe you only want to trade 500. In other words, to take these things into consideration. And you'd be surprised by just being aware of it and taking into consideration. A lot of times these things will reconcile themselves. Does that help you?
Yes, it does. Thanks.
Okay, and the last area of these broad skill sets that we're talking about is develop the ability to recognize if you've crossed the threshold from normal self-confidence into a state of euphoria. You guys are laughing. I finally got some giggles out of you guys here. What's so funny about this? Anybody want to share? What? What's that?
You don't want to be in a state of euphoria.
No, you're right. I mean, being in a state of euphoria, let's put it this way. The primary, let's say, the primary characteristic of the state of euphoria is that it's a state of mind of complete and absolute risklessness. Did everybody get what I just said? You are in a state of risklessness. In other words, you have no ability whatsoever to perceive risk. So if, for an example, if this line right here, if below this line represents normal self-confidence, and above this line is euphoria, and this threshold's different for everybody, by the way. I mean, there are certain chemicals that scientists have found that, that flood our mind and our body when we've crossed this threshold. I've worked with traders who will flip into a state of euphoria with one winning trade. Okay, usually for most people it takes more than one winning trade. But I have worked with people that they'll flip into a state of euphoria with one winning trade. Now the problem with this, and it's a great state of mind to be in. I mean, to be in in virtually a riskless state of mind. I mean, it's like, hey, it's really a cool place to be. But the problem is that when we're in a state of euphoria as a trader, it's virtually guaranteed that we're going to make a trading error. And the kind of trading error that we'll make in a state of euphoria usually has to do with position size. So for an example, if you normally only trade 1,000 shares, in a state of euphoria, it's like, okay, let's mortgage the house. Okay? It's like, let's go to 10,000, 20, 30, whatever. 1,000 shares. Because, you see, you absolutely know for a fact you wouldn't be putting this trade on if it wasn't going to work. See, you know for a fact. See, because you don't have any ability to perceive risk at all. Now the problem, even though it could even end up being a winning trade, it's not that the trade might not end up being a winner, but here's typically what's going to happen. If you're a normal 1,000 share trader and you go up to 10,000 shares, if when you put 1,000 shares on and the market went against you 5 cents a share, wouldn't be any big deal. You got 10,000 shares on when you absolutely knew for a fact that the trade was a winner, and it goes 5 or 10 cents against you. It has the potential to flip you into a state of pure, unadulterated terror. Instantaneously, you'll go from euphoria to a state of terror in one instant, because your expectations about what was going to happen were so resolute, it creates a psychological shock that puts you in a state of mind freeze. Mind freeze. Mind freeze is when you are conscious of what is happening, but find yourself totally immobilized to do anything about it. And so if the market happens to go 10 cents against you but keeps on going, okay, you just sit there and watch, completely immobilized, while the market takes your money away, until finally something flips you out of that. And you say, hey, you just come back to your senses and you had enough and you get out of the trade. I know this probably never happened to anybody in this group, but but I've worked with many people who it has happened with. So this is not something unfamiliar to anybody here.
The terror part,
It's like going literally from a state of mind, it's like literally going from heaven to hell instantaneously. And keep in mind the dynamics here. It was all based on your expectation. It's all based on your expectation. So you guys have got this? Okay, so when we're talking about consistency, see, this goes back to when I was doing the contrast, okay, is that to experience a winning trade, you need nothing. I'm not saying that you don't put something into it, but the fact is you need nothing. There's no skills that are required to experience a winning trade. But to experience consistent results as a trader, the kind of results that you can rely on as an income, there's some pretty kind of profound skills that we're talking about, are we not? You got to have an edge. You got to have a plan on how to execute the edge. You got to be able to execute the plan flawlessly, or at least without a minimum number of errors, or otherwise they're going to detract from your results. You got to be able to recognize when you might have some self-sabotaging beliefs that are rising to the surface, to saying, hey, this is too much money. Why do you think it is that you have probably read in some of the trading books, I'm sure you have read at some point, that someone gives you the advice that when you have windfall profits to stop trading and take a vacation? Why do you think that advice exists? Why do you think people have written that down? I just gave you the underlying dynamics for why that's true. It's not just the euphoria. No, it's not the terror afterward. It's the possibility for self-sabotaging beliefs coming in and saying, I am not worth this much money. Even though it's what I want. It's what I desire. It's what I've been working for. It doesn't mean that you believe you really deserve it. You have to believe you really deserve it to keep it. Or at least recognize that you don't necessarily believe it and don't do anything to give it away. In other words, take a vacation, put it in the bank, let yourself get used to having it, and at which point you'll say, you know what, yeah, I do deserve this money. And then you'll be less likely to give it away. One of the best examples that I could give you to illustrate this is a floor trader that I work with. Again, another bond trader, not as big as the other bond trader that I referred to earlier. He was the kind of trader who had this reputation as being completely consistent. When I met him, he would make anywhere from, I'd say, $15,000 to $20,000 a day. That was his daily thing. Okay. Day in, day out, $15,000, $20,000 a day. Never had these catastrophic bad days. That was his reputation. And it was true. And so what did he need me for? Well, he had hired a bunch of guys to trade his money, thinking that he's going to, this is very common. You kind of have a funny look, but this is very common in Chicago, where once you become successful and established, what you want to do is bring in, as many, let's say, bring in young talent that you can, teach your particular techniques and just, multiply what you make based on their efforts. I mean, that's, but the problem is that the guys that he brought into his group, they were, I mean, I don't know how to put it. I want to be nice. They were just basically leeches. I mean, a lot of them, when I, talk to them, it's like, there's some of them I don't even think wanted to be traders. They just saw the opportunity to be able to get money from him and the opportunity to do something they hadn't done before. And it was, these were not the kind of people that you would hire under these circumstances. They weren't really suited for it. In many cases, weren't really suited for it at all, especially to trade down on the floor. So he wanted ideas on how to build this group up into a really successful trading group. And while we were talking one day, we had ordered lunch in. A delivery person came with the lunch, and he was a devout Catholic, by the way. This is a very important part of this. He was a devout Catholic, and he's so devout that he carried a rosary with him all the time. He had a rosary in his pocket. And so when he paid, took his wallet out of his pocket, paid for the lunch, and he took the change, and he just sort of unconsciously started to put the change in the same pocket with his rosary. And then we realized what he was doing. He took his hand out like that. And I said, well, hey, what's going on? He said, well, I can't put money in, can't have money touch the rosary. And so we started exploring his beliefs about money and his beliefs about religion in relationship to money, and certainly his beliefs about the Catholic Church and their beliefs about money. And, and it's something he never really thought about. But when he thought about, the Catholic Church certainly doesn't believe that money's dirty. So why should he believe that money's dirty? In that respect. In other words, it's not spiritual to have money. in a way that, in a can, in other words, there's a dichotomy in his mind between his ability to make money in the pit, and yet you would think that in this kind of a situation, he would be giving his money away because he felt guilty about having it. Well, he didn't give it away as a trader because he was just too strong of a trader to do it. But he was giving it away with this organization, the kind of people that he had around him. In other words, it wasn't going out the front door, the money was going out the back door. So he did find a way to extract that money about his beliefs about money, religion, the Catholic Church, their beliefs about money, realize the inconsistencies. And so as we're coming to kind of reconciliation about this, I gave him an exercise to see if in fact he'd really accepted what it is that we were talking about. And what do you think the exercise was? Come on, what do you think the exercise was? It's not that hard.
Go ahead, put some money in that pocket.
Yeah, that's right. Put money in the pocket with the rosary. Put the money and the rosary together. He couldn't do it. He literally, his arm, he tried to put the money in. It was like it got like he could not do it. His beliefs that we talked about were so strong that it literally wouldn't consciously let him do it. But he worked on it. See, he wanted to get to the point where he recognized the validity of the things that we were talking about, and so he did want to do it, and so he kept on trying. It took him about a week. And once he got the money in with the rosary, he had like all these conflicting beliefs he had about the nature of money and the guilt that he felt over it. They just sort of all melted away, and he fired all these people. He didn't even try to make them traders because he realized that these were not guys that really wanted to be traders. He realized what he was doing. He realized he was just giving his money away. What gives the professional trader the ability to execute their trades without error? They are confident, meaning they are no longer encumbered by the same fears that plague the typical trader. Trading without fears is learned mental skills. I've already given you examples of mental skills. Remember what did we say about the ability not to choke? Okay, that would be an example of a mental skill. Learning to trade without fear, hesitation, or internal conflicts is a function of believing that you don't have to know what's going to happen next on a trade-by-trade basis to win or make consistent money. This is the heart of it right here, everyone. Okay? This is the heart of it. And again, we're still in the introduction, believe it or not. Okay? So I'm going to reinforce all this. But eventually, what you're going to do is get to the point where you believe that you do not have to know what is going to happen next on a trade-by-trade basis. This trade and this particular trade and this particular trade, you don't have to enter these trades thinking that you know what's going to happen next to win, to make consistent money. And that when you stop believing that, you will start making consistent money. Because it's your expectations about this trade winning that's going to mess you up. Go ahead.
What you're really saying is you have to have a belief in your plan or your methodology, and you're looking for a probabilistic result saying, over a period of time, I will execute 60, 70, 80% of my trades. The one I'm going into now could be a good one, could be a bad one.
That's right.
I don't care.
That's right. Exactly right. Perfect. Thank you. This is where we're going. Okay? Thinking, assuming, or believing you know what will happen next creates an unrealistic expectation in a specific outcome. What's wrong with an unrealistic expectation? Well, think about, let's say, expectations in relationship to the characteristics of humanity. This cuts across everybody and cuts across all cultural lines or barriers. Everyone, well, first of all, before we can get to that point, what is an expectation? An expectation is a mental representation. In other words, a belief, an assumption, or an opinion, or whatever, thinking, assuming, or believing, a mental representation of what the next moment, meaning next moment, next 5 seconds, or the next in 10 seconds, or the next hour, or whatever, is either going to, in the environment. In other words, we have a mental representation, and we have an external environment that expresses itself, okay? So my mental representation, meaning my expectation, if the environment shows up in a way that is consistent with what I believe, then what will my state of mind be? This is a universal characteristic of humanity. This isn't any different with anybody, anywhere. How will I feel? What will be my state of mind? What will be my experience? I'll be in a state of satisfaction, a state of well-being. I could be joyous. I could even end up in a state of euphoria. The degree to which the environment does not express itself in a way that's consistent, consistent with the way I think it's either going to look like, sound like, taste like, smell like, or feel like, okay? I will be in a state of dissatisfaction, a state of betrayal, disgust, anger, fear, terror. Your ability to create consistent results as a trader is all about what you expect. When you change your expectations to be consistent with the way the environment, the market environment exists, the fear will go away. When you change your expectations in a way that's consistent with the way the actual market environment exists, your fear will go away. And you'll be able to do exactly what you need to do when you need to do it, without conflict, without hesitation, and be able to close that profit gap between what your methodology will give you and what you end up with in your bottom line. Unrealistic expectations cause us to define and interpret and therefore perceive market information as threatening. Ultimately, we can break the market down to its lowest definable component parts. If we break the market down to its lowest definable component parts, what we end up with is up and down ticks. Okay? An uptick is one incremental price change with a price move from 1 to 2, from 2 to 3, 4, 5, 6, whatever, and then down ticks. Okay? When we're operating out of unrealistic expectations, we're going to tap into 4 primary trading fears that will cause all the errors that we make as traders. Those fears are the fear of being wrong, losing money, missing out, and leaving money on the table. And those fears will actually cause us to perceive these up and down ticks as threatening. And what we're going to learn about the nature of fear a little later is that fear will cause us to focus on the object of our fear so that we end up creating the very experience we're trying to avoid. Therefore, if I'm afraid of being wrong, I will actually perceive this information in a way that causes me to be wrong. If I'm afraid of losing, I will perceive these up and down ticks in a way that will actually cause me to lose. If I'm afraid of missing out, I'll actually create the experience of missing out. And if I'm afraid of leaving money on the table, that's exactly what I'll end up doing. Now, when you think about the nature of these up and down ticks and the photons that appear on your computer screens, is there an inherent characteristic in that information that's threatening in any way? In other words, is it information? In other words, when we talk about the nature of emotional pain, which is the threat of pain, okay, the fear, not physical pain, where we have all of us have a normal nervous system, and we come into contact with a physical object, if I hit this with my arm, it's going to hurt. If you hit it with your arm, it's going to hurt. So we've got some universal commonality. But with emotional pain, it's not that way at all. Although we think that it is, it's not. Because emotional pain requires an interpretation. And then interpretation comes from what we believe. You guys with me on this, on the interpretation part? Because, see, the information itself, the up and down ticks, have no charge to them whatsoever. They're not positively or negatively charged. They're just up and down ticks. that based on your ability to read those up and down ticks tell you what the potential is for the market to move in any particular direction. If you're perceiving them as threatening in some way, that's definitely going to cause you problems when it comes to creating consistent results. In fact, you're going to find it impossible. Okay, let's talk about some typical trading errors. The typical trading errors the professional has evolved beyond. Don't define the risk in advance of putting on a trade. Why in the world, now, of all the trading books that you've ever read, out of all the workshops you've probably been to, I'm sure that you have been exposed to this particular piece of advice countless times. And yet, it is the primary trading error that people commit all the time. They don't predefine the risk in advance of putting on a trade. If you don't predefine the risk in advance, you're operating out of the mindset that you think you know what's going to happen next. And what I'm going to establish for you when we get into the next section is that that is absolutely not the case. It doesn't mean we don't think that, but the reality is it isn't the case. See, because when we predefine our risk, let's put it this way. If I'm a typical trader operating out of the four fundamental fears, the fear of being wrong, the fear of missing out, losing money, etc., we got a real problem here because our minds are naturally wired to associate. In other words, our minds will automatically make connections, meaning this, that if I get into a trade and I end up being wrong, I expect it to win and I'm wrong. I have to admit that I'm wrong. It isn't just admitting that I'm wrong on this one trade. Our minds, because the way our minds are wired, it has the potential to tap us into the accumulated negative energy of every time I've been wrong in my life. Okay? So if this circle represents a huge ball of negative energy inside of our mental environment about what it means to be wrong, being wrong on just one trade could tap us into that pain. And it's going to work differently for everybody. Everyone's minds works a little bit differently. But that's the potential. If you wonder why people seem to live and die on the outcome of the next trade, this is one of the reasons why. This is why it's so important. Because it has the potential to tap us into the accumulated negative pain of every time we've been wrong in our lives. Every time we've lost something in our lives. Every time we've missed out on an opportunity that we didn't take advantage of. Every time we've been in an opportunity and didn't get the maximum amount that was available. Those are the four fears. So the problem with predefining our risk is this, is that if I'm afraid of being wrong, and I don't know how to think about trading appropriately in a probabilistic mindset, I'm not going to get into this trade unless I think I'm right. And the problem with predefining the risk is that it requires that I gather evidence as to why it might not work. Predefining your risk requires that you gather evidence as to why it might not work. Well, I wouldn't even be getting into it in the first place if that were the case. So I'm going to gather as much evidence as possible to make sure that I'm doing the right thing. Because if I start gathering evidence as to why it might not work, then I might talk myself out of taking the trade. And then if I end up talking myself out of taking the trade and it turns out to be a winner, I'll probably be in more emotional pain than what I would have been in had I taken the trade and it turned out to be a loser. So I just make sure that I've got all my ducks in a row and I don't take the trade unless I do. And therefore, what I have done, now think about this, what I have essentially done is define the risk out of the trade. I've gone through a mental process in which I have literally defined the risk out of the trade. Why do I have to put a stop in the market and predefine my risk if I know I'm going to win? A professional trader just doesn't think that way. They would not. I'm not saying that they never thought that way. I'm not saying that they didn't experience the exact same thought process that I just took you through. I'm saying they have evolved beyond it. They would never allow themselves to get into a trade without predefining the risk. In other words, what does the market have to look like, sound like, or feel like to tell me this trade isn't working? The next error, define the risk but don't take the loss, and it turns out to be a bigger loss. That's probably one of those things that never happened to anybody in this room, but just in case someone watches the DVD where this sort of thing has happened, I included it. Same dynamics, basically. Hesitate, get in too late. Why are you going to hesitate? Why are you going to hesitate to get in? If the criteria that you use to define an edge is present in this moment, why would you hesitate? Because you don't think the trade's going to work. You have doubt. In other words, you are either thinking, believing, or assuming that you know what's going to happen next. Think of the connection here. You couldn't hesitate unless you either assumed, think, or believed that you know what's going to happen next. If you operate out of the perspective that you don't know what's going to happen next, I don't need to know what's going to happen next to make money, then there's no point in hesitating. Jump the gun. Get in too soon where the signal never actually develops. Coming off of a winning trade. You're going to jump the gun when you come off a winning trade or a series of winning trades, right? And you're just so excited about what you see developing. The signal isn't quite there yet. But you know what? Let's get in before everyone else. And you never actually get a signal. That's a trading error. Now see, the point, that doesn't mean that you couldn't win. See, what you're going to find is that when you trade on what I call a trade-by-trade basis, so we're going to make the distinction between trading trade by trade and trading over a series of trades. When you trade by trade, it means that each individual trade is like a life or death thing. In other words, I wouldn't be putting this trade on if I didn't think this trade was going to win. Not the opposite of that, which is I'm going to put on the next 20 trades because I think that 70 or 75% of them or 50% of them are going to win. There's a huge difference in perspective. So if you're coming off a winning trade or a series of wins, you're likely to jump the gun. But the interesting part about all this is that each one of these errors that I'm giving you could all result in a winning trade. You could do every single one of these things and still win. You could not predefine your risk and still find yourself in a winning trade. You can hesitate and find out it's exactly the right thing to do in that moment. You can jump the gun and find out it's exactly the right thing to do in that moment. You can not take your loss and the market comes back in your favor. All these errors that we're talking about, you can commit over and over again, and they could end up you could end up experiencing positive results. Except one thing is that when you indulge yourself in behaviors, in these kinds of behaviors, it could lead to virtually every time leads to a catastrophic loss. Catastrophic. You put on a trade without predefining your risk 3 or 4 times in a row and turns out to be a winner. And then the next one, you don't do it. That's the one that's going to be the catastrophic loss. See, so on a trade-by-trade basis, you can do anything for any reason and commit any error or what would be considered an error in the perspective of trying to create consistency and still win and still have winning streaks and still have a lot of fun. But you're setting yourself up for catastrophic losses. Get out of a winning trade too soon and leave money on the table. There isn't a trader alive who hasn't experienced that. Let a winning trade turn into a loser without having taken any profits. All these errors are the result of thinking, assuming, or believing that we know what's going to happen next. Move a stop closer to an entry point, get stopped out, and the market trades back in your favor. In other words, what would that tell you? If you're here, if you buy at this price right here, and you put your stop here, this is all you're really saying is that this is how far I'm going to let the market trade against my position to tell me that this trade is either not working at all, or that the potential for it working is so diminished that it's not worth me staying in any longer. And then the market starts to drift down to your stop, and then you move your stop up and again get stopped out, and then the market does this. What would that tell you about your attitude? What? Yeah, and you hadn't accepted the risk of that trade, did you? See, people can put stops in the market. It doesn't mean they've really accepted the risk. You can put a stop in the market, but it doesn't mean you've genuinely accepted the risk. This would tell me, someone came to me and said, Mark, this is what I did. This is what I know. I know that you didn't accept the risk of that trade or you wouldn't have moved the stop.
Move it the other way, too.
What?
You can move it the other way.
Yeah, you can move the other way, too, you know, because, that's because you don't want to admit you're wrong. The professional trader is no longer susceptible to these typical trading errors because he's learned to think in probabilities. When you understand the relationship between how prices move and the mathematical formulas and price patterns that make up a trading methodology, quantifies that movement into tradable edges, then why you have to learn the skill of thinking probabilities will become self-evident. In other words, when we get through the next section, the way you need to think, I want you guys to be at a point where it just becomes completely self-evident as to why you need to think in probabilities to make consistent money. It just makes sense. It's just like, oh, yeah, okay. This makes absolute sense. The 3 developmental modes of trading. Now, I gave you the broad skill sets that you have to learn to create consistency. Well, those broad skill sets are within the 3, what I call 3 developmental modes of trading. There's mechanical trading, subjective trading, and intuitive trading. There's 3 stages. In other words, in mechanical, what you want to do is you want to trade with a rigid criteria that defines your edge. All execution decisions are made in advance of market activity. The market either conforms to your definition of an edge or not, and you execute your trades based on a plan. In other words, what you're doing in the mechanical mode of trading is you're limiting the number of variables that you're dealing with in the market. Because what you want to find out is this. You want to find out what works and what doesn't. This is where, to find out what works and what doesn't, you can paper trade. In other words, you can actually take a particular trading strategy and methodology and forward trade it with paper trading, or if you've got software that does the analysis for you, you can do it that way too. But it's better to probably paper trade it so that you're actually interacting with your particular variables that are defining an edge. So you're finding out what works and what doesn't. If you use an unlimited number of variables to define an edge, when you're trading randomly, you never find out what works and what doesn't. So you have to learn that. You have to have confidence in that. But the other part of it, too, is finding out whether or not your own personal psychology is made up in a way that you can actually execute that edge. And the problem with the execution part of it is that paper trading doesn't cut it. You actually have to have money on the line. And so what you do in the mechanical stage is that you use the mechanical stage as a means to learn trading skills. In other words, your focus is on skills and not necessarily on how much money you're making or not making. Because when you've acquired the appropriate skills, the money will simply just be a byproduct of those skills. And then what you do is that if you find that you cannot execute your plan, then you're going to have to get into a mode where you learn exactly how to do that, which is what we're going to get into later on. But the point is that what I recommend to people is that if they're having problems executing their trades, in most cases it's because their position size is too large. In other words, once they learn that there's a specific regimen in which they can learn to be consistent. You know, what they want to do is they want their cake and eat it too, sort of. In other words, they want to learn the techniques, but they don't want to cut themselves off from still making a lot of money. When the reality is they don't have the psychological skills to be able to execute trades based on the way they were trading before. So if they were a 5,000 share trader before, they'll set up these exercises that we're going to talk about later on in the afternoon with 5,000 shares and then completely blow it and can't do it. The reality is their psychological makeup is such that they may only be able to do it flawlessly with 10 shares. So I work with people who had to go down to 1. To be able to execute it flawlessly, they had to go down to 1 share. And then they work their way up. Then they go to 2, and then they go to 5, they go to 10. They just work their way up. I mean, is there anybody in this room who hasn't paper traded? And is there anybody in the room who hasn't experienced being able to execute your trades flawlessly on paper? But then when you try to execute your plan with real money, it doesn't work? See, the plan's working, you're not working. This is what mechanical trading is all about, okay? Mechanical trading is finding out just how big that gap is. You cannot take for granted that because you recognize an opportunity to enrich yourself in some way, that you have the skills to be able to take advantage of it appropriately. You can't take it for granted, and everybody does. So mechanical trading gives you all this information. It tells you what works and what doesn't in the market and what works and what doesn't with you. So that you know what you need to focus on to be able to make consistent money. You guys with me on this? Yes. Is it making sense? Okay, then you can evolve, if you want, to the subjective stage of trading, because you can make consistent money trading mechanically. Okay, but most people like to be able to use their rational thinking and process and try to figure things out. And the subjective stage of trading is simply, this is a broader, more flexible mode of trading where you use everything you've ever learned about the price movement to determine your edges. In other words, all the different patterns you've learned, all the different nuances of market behavior will determine, where you get in, how much profit you take, where you set your stops. You see, in the subjective mode of trading, if someone said to me, okay, I'm buying here and my stop is here, but the market's starting to come down to my stop and I get out right here and I don't let myself get stopped out at my original spot. Truly, for someone who's evolved to the subjective mode of trading, that's all right. You can do that. Because you're not doing it out of fear, or you're not doing it out of the fact that you haven't accepted the risk. You're doing it because you recognize the pattern that the market is giving you is such that there's a high probability you are going to get stopped out, and so therefore you might as well just scratch your trade or get out with a little bit of a loss. It's not because you're afraid. There's a huge difference. You guys with me on this? And then the last stage is the intuitive. This is the most advanced mode of trading. It would be the equivalent to getting a black belt in martial arts. It's when you find yourself in the zone, tapped into the collective consciousness of the market, giving you a sense of the flow. If you look at the market as being, a collection of individuals, you can tap into that. You can find yourself. It's not something you can will yourself into. You just find yourself into this zone where you're just seeing and doing things that you can't necessarily explain at a rational level. And the problem is that there are people. Everyone has intuitive capabilities. But some people it's completely shut off, and with others, they don't trust it because, they can't make the distinction between what's intuition and what's just their mind hoping that something's going to happen, or hoping that what they see is really what's going on, and making it feel like intuition. The problem is, until you've acquired these fundamental skills that we're talking about, you definitely don't want to be trading based on intuitive impulses. You just want to make note of them. When you've got the skills, then find yourself in the zone, then go ahead and do whatever comes to your brain until you flip yourself out of it. Meaning, when you start thinking at a rational level, you flip yourself right out of the zone. because your rational mind wants to know, wants reasons. Your rational mind wants logical reasons, and these intuitive impulses don't come from that part of your brain. They come from that creative part of your brain. And by definition, creativity is bringing something forth that didn't previously exist. It may exist somewhere in the world or in the universe somewhere, but it didn't exist in your mind, and it's outside the parameters of what you already believe. So there's going to be an instant conflict between what you think at a rational level and your intuitive impulses until you train your rational mind to accept your intuitive impulses. Got that? In this section, we're going to discuss how prices move and who the players are behind it. When you understand how traders make prices move, then how you need to think to generate consistent results will start to become clear to you. Okay, where we're going now is that I think what I said when just before the break is that when you guys understand the nature of price movement and how any technical methodology that's based on a mathematical formula or a price pattern interacts with that movement, when you understand that relationship, how you need to think will become self-evident. Do you remember me saying that? Okay, this is the part that we're going into right now, okay? In other words, where you understand just exactly how prices move. Because what I found in doing these workshops over the years is that here I'm addressing a group of people who trade and who in many cases have traded for years. And if you ask somebody exactly how do prices get from one price to the next, they can't tell you. They don't know. They don't know how it happens. And maybe you guys are, I'm sure you guys aren't that group, but we'll go over it just as a refresher, okay? we'll do it as a kind of refresher. So, oh. No, actually, I haven't addressed a group yet that there were very few people, or if anybody, could tell you exactly how prices move from one price level to the next. So, for an example, 10, 9, 7, 6, 11. Okay. If the last reported price that you see on your screen of something is 10, how does it get to 11?
They asked 12.
What?
They asked 12.
Who's they?
Market maker.
The market maker asked 12, okay? Well, no. Well, okay, it's at 10. How does it get to 11? How does the price actually move to 11?
More buyers.
Well, more buyers, but that's true. But then again, when you what's that? Demand, okay. But when you look at 10, what you have is you have offers at 11 and you have bids at 9, right? Everybody understands that? Okay, now, there's only two ways that anybody can make money in this business. There's only two possible ways, no matter what strategies you're employing, no matter how elaborate they are, no matter how simple they are. You have to be able to buy something at a low price and sell it back at a higher price, or sell something at a high price and buy it back at a lower price. Are we in agreement on that? And would you also agree that everyone that trades is trading to make money? Yes. In other words, I'm going to say that there isn't anybody who puts on a trade that does so knowingly and consciously thinking it's going to be a loser. In other words, when they go into the market and say, my purpose is to lose money. Okay, you guys with me on this? Now, if the only way that you can make money is to buy low and sell high, or sell high and buy low, and the last price, posted price, is 10, which represents the value at that moment, then what's low? 9 is low, and what's high? 11. What's the only way that it can get to 11? Somebody thinks 11 is a good price, meaning that they have to buy high relative to the last price, right? So for an example, so basically what this also means is that all the offers have to be taken out at 10, do they not? Anybody who had an offer in at 10 that wanted to sell at 10 will get filled, and all those offers have to be taken out for the price to go to 11. Correct? And of course, and for the price to go to 12, all the offers that exist at 11 have to be taken out so that someone could actually bid the price up to 12. For prices to move, somebody literally has to bid the market up. Or for prices to go lower, it means that someone has to offer it lower. Now, if the only way that anyone can make money is to buy low and sell high and buy low, why in the world would anybody bid the market past the last posted price?
Because he thinks he got a winner.
Conviction, exactly. Conviction. In other words, what you have is a situation where on every trade that exists, there are two people on both sides of the trade. Even in stocks, there's even someone who's selling a stock, not like a commodity where in a futures contract or an options contract, there's two people on both sides of the trade. There's a buyer and there's a seller, and the next tick is going to make one of them a winner and one of them a loser, right off the bat. If you and I enter into a trade at 10, okay? We enter into a trade at 10. It means that you, in essence, if you're the seller, let's say you sold them at 10 and I bought them at 10. The next tick is going to make one of us a winner and one of us a loser. If the next tick is 9, the amount of money that flows into your account is coming directly out of mine. Are you guys with me on this? If the next tick is 11, the amount of money flowing into my account is coming directly out of your account. Okay? So basically what you have is you have two diametrically opposing beliefs entering into every single trade. Every trade that is made, there are diametrically opposing beliefs about what the future is going to be. So again, I'm going to say, what would cause anybody to buy high or sell low? Just conviction. In other words, what you have is a situation where if someone's willing to bid a market up to the next highest price, basically what that person is doing is that person is stepping out, saying that my conviction that the price is going to go to 12 or beyond is so great that I am willing to do the opposite of what I need to do to make money. Think about what I just said. I am willing to do the opposite of what I need to do to make money because my conviction is so strong that the next price will be 12 or 13. Otherwise, this person would wait. If this person thought the next price was going to be 9, then they'd buy lower. If they thought it was going to be 8, they'd buy low. They'd wait and buy lower. Whereas, so what happens is that the person who's willing to bid a market up and take out these offers at 10, take out all the offers at 10 and bid it up to 11, has to have a stronger conviction in the future than the person who sold it to him at 11. Because this person is creating price movement, is actually creating movement, and the person on the other side of the trade is being passive because they're doing exactly what they think they need to do, and that's sell high relative to the last price. Are you guys with me on this? Okay, everybody understand it? Now, I want to ask you, is there anybody in this room who has purposefully bid up a market? There are some people who've actually bid a market up. In other words, the people who've actually taken the offers, all the offers out at the next highest price and bid it up. Do people like that exist? Yes. So in other words, we are aware of the fact that there are traders who both have the financial and the psychological resources to actually purposefully bid markets up or offer them lower. We're together on this, right? So basically what you have is that all price movement has to be a result of an imbalance in the degree of conviction between the traders who believe that prices are going up and those who believe that it's going down. That is the only way that prices move. It doesn't matter what the reasons are that people tell you about why they did what they did. Or it doesn't matter what the reasons that you hear on CNBC or whatever about where the market is and why it went the way that it went. Ultimately, it all boils down to an imbalance in conviction. That's the only way prices can move. Because the only way they can move is for someone to actually purposefully bid it up or offer it lower. And for them to do it, there has to be, you know, like a sense of strength in terms of energy in their belief that the next tick is going to make them a winner. Okay, so we basically, does everybody understand? Everyone's with me on this. All price movement is a result of an imbalance in conviction between the buyers and the sellers. Every trade that's made, there's somebody on both sides of the trade that have diametrically opposing beliefs. You're always having, with every single trade, there's always a clash. There's always a clash in wills and a clash in belief in terms of what the next tick is going to be or what the future holds. We've got two people entering into, in a sense, an agreement by making a trade, but both of those people have diametrically opposing expectations of the future. And one of them is willing to say, hey, you know what? My expectation is so great, is so strong, that I am actually willing to do the opposite of what I need to do to make money and bid a market up. Now, there are traders who will do that. I call them dynamic traders. They are the people that have, like I said, both the financial and the psychological resources to actually bid markets up. What the typical, and what I'm going to call everyone else, passive technical traders, okay, they've got dynamic traders and passive technical traders. What the typical passive technical trader doesn't really, I'd say, really not aware of or think about is the fact that the only way that they will find themselves in a winning trade is by the actions of the people who are willing to bid a market up and offer it lower. That's the only way that it happens. In other words, when you and I get into a trade, I am a passive technical trader, by the way. I'm not one of these dynamic guys. I don't bid markets up and offer them lower. Okay? That when you and I get into a trade at this price right here, let's say we bought at 7, we're buyers at 7. What are we really saying when we get into that trade? Bottom line, what are we saying? Based on the dynamics of what I just explained. We're saying that I think that someone is going to come into the market after me and buy at a worse price than what I did. That has such a strong conviction that this market is going to go up, that person is actually willing to buy at a worse price than me, to buy at 8, to buy at 9, to buy at 10. Because if there isn't anybody else that comes into the market to take out all the offers at 8, take all the offers at 9, take out all the offers at 10, that market ain't going up. And I'm not going to be in a winning trade. You see, the implications are every single trade that we put on as passive technical traders, we are in fact obliged and dependent on other people who are willing to do something at a worse price than what we did it at. Or we won't be a winner. Are you guys following me on this? Is it starting to put the idea of trading into a different context? That in essence, what you're really trading is other people's perception of what is high and what is low? That any technical indicator, any price pattern that you might trade, any trade that you put on, you are basically trading other people's perceptions of what is high and what is low. Now, when you think about how well you might know other people's perceptions, you think about it in that context, it might not make a lot of sense to get so fixated on staying in a trade that isn't working. It might be a little easier to put in a stop. And to say, hey, you know what? If people aren't coming in to buy at a higher price than me, I'm going to give them this much room from here to here, and if they don't come in, I'm out of this trade. I'll just go to the next one. Because that's basically what you're doing as a trader. You are completely dependent on other traders to make you a winner. Now, who are these dynamic traders? Who are the people that are going to do this and why? What? Hedge funds, okay? Money managers. In the commodities arena, do you guys really know how, like, the futures markets even started in the first place? Or why they even exist? I know people probably exist because they're on the screen and it's part of the platform, but, you know, there's actually a legitimate economic purpose for these things. And when you get to the underlying, when you understand the underlying reason for these markets, you'll understand why they trade the way that they do and why prices move the way that they do. For an example, what happened in the past is that, for an example, if you had a farmer who who planted their corn in the spring and harvested the corn in the fall, what they were dependent on, of course, was a lot of different factors that they had no control of. One of them being the weather, and one of them being how much other corn was planted out throughout the country, and how much of that corn would end up in the market in the fall in relationship to what the demand was. So if there was a lot of corn and let's say the demand remained relatively constant, the price of the corn would go down and the farmer would lose money. If there wasn't a lot of corn and demand would remain constant, the price would go up. If there wasn't a lot of corn and for some reason demand was really high, and the price would go up even further. So what you had is a situation where there was a great deal of economic risk in being a farmer or being anybody that manufactured anything or dug stuff out of the ground like gold or silver or manufactured electric motors that needed copper or whatever goes into all the products that we use. So what evolved was a situation where the farmer and the manufacturer, let's say of bread that needed the flour, they would enter into what was called a forward agreement, meaning that they both wanted the economic risk taken out of their business. They both wanted to be able to make a profit. They both wanted, to be able to have some sense of certainty as to what prices might be at some point in the future. So for an example, if I'm a farmer and it costs me $4 a bushel to plant my corn and bring it to harvest or bring it to market, then for me to make some money, I want at least $5 a bushel, right? And if I'm the guy on the other end of that trade or the other end of that transaction that wants to buy that corn in the fall or wheat or whatever, and I want to know exactly how much I'm going to have to pay for it. So what ends up happening is that if, let's say, it's April or it's March, and the price of corn is $4 a bushel, you enter into a forward agreement with the end user, and they say, hey, you know what? I will deliver $1 million or 1 million bushels of corn or 100,000 bushels of corn at say $4.50 a bushel or whatever price they agree on $5 a bushel, regardless of what the price of corn is in the fall. So if the price of corn in the fall happens to be $3 a bushel because there's so much demand, or because there's so much corn and very little demand, then the farmer actually still got his price at, let's say, $5 a bushel, but the manufacturer ended up having to pay $2 a bushel more than what he would have if he had waited and just bought his corn on the open market in the fall. So in that sense, he seemed to lose on that transaction. But then the next year, what ends up happening is that there's very little corn, or there's more demand than what there is corn, and the price of corn ends up being $7 a bushel. And the farmer would have made the $7 had he not entered into a forward agreement. But what ends up happening is he still made his $1 a bushel profit, and the end user ended up saving himself $2 a bushel. So over the years, all this evens out. Well, so then what happened then is that exchanges, in other words, instead of these people individually entering into these transactions, exchanges were developed. So in other words, they had a central place to come to and make these transactions, like the Chicago Board of Trade and Chicago Mercantile Exchange. Well, what ended up happening is that with the advent of exchanges, what you had is a situation where there were people that were willing to take the other sides of these trades that had nothing to do with the actual process of making bread or growing wheat or corn. They were called speculators. And then that's when futures contracts, came into being. So what would happen is that if I'm a farmer, instead of me having to make the transaction directly with with someone who manufactures bread, I could go to the Chicago Board of Trade and sell my corn or wheat with a futures contract. And so if I'm selling it at $4 a bushel, and so that means I'm long corn. This is where the long and the short comes from. I am long cash. I'm long corn, and because I've got a crop in the ground. And so if If I sell it at $4 a bushel on a futures contract, I take the equivalent number of futures contracts. And so if the price of corn goes down, or let's say the price of corn goes up, I've already locked in, well, I'm going to sell at $5, but I've locked in my dollar bushel profit. So if the price of corn goes up, what I've done is I'm short futures. I'm short the actual futures contract. I'm long the corn. So I'm going to lose money on my futures contract because as the price goes up, I'm losing money, but I'm making money on my cash. So I'm making the equivalent amount of money on my cash as what I'm losing on my futures. So in any case, it doesn't matter what the market does. The market can go up, the market can go down. I've locked in my dollar profit bushel, a dollar per bushel profit. And the person on the other side of that trade, the speculator, if of course the market goes up, then the speculator is the one that makes that $2 a bushel profit if it goes up to $7 a bushel. Okay? You guys with me on all this? If the price, of course, if the price of it goes down, then I'm losing money. I'm losing money on my cash crop, but I'm making money on my futures contract. And the speculator on the other side of the contract is losing money because the market's going down. In other words, the speculator is just one-sided. The farmer is two-sided. He is hedged. That's what's called a hedge. Now, what's interesting about all this is that as these markets evolved, you will find that the farmers don't trade against each other, or the grain elevators, or the people the commercials who actually are involved with the production and manufacture of anything. They don't take the other side of each other's trades. What they do is they want speculators to take the other sides of their trades. In other words, if I'm a commercial grain elevator, I'm not going to be another commercial grain elevator is not going to be taking the other side of my trade because we're both going to be doing the same thing. Okay, if I'm a farmer and I'm going to sell my wheat or sell my corn, the farmer down the street who also trades isn't going to be taking the other side of my trades. What commercials and hedgers and fund managers and all the people who are really, let's say, professionals, they have become very, very sophisticated at finding ways of drawing the general public into taking the other sides of their trades. Meaning, and the point that I'm making here, is that they will purposefully do things that will draw the typical general public, let's say the general public, into the other side of their trades, when in fact what they want to do is the exact opposite. For an example, let's if I'm a hedge fund manager and I'm long stocks, or it doesn't really matter what it is. I could be long bonds, I could be long gold, I could be whatever it is, and I want to liquidate my position. Now I've got a huge position, meaning I've got a cash position, and I want to sell it. If I go into the market right now and sell my entire position, what do you think is going to happen to the price? Chances are it's going to go down. I am actually going to, because of the volume of my trades, I am actually going to drive the price down, making my average cost lower and lower. I don't want to do that. I don't want to, so for an example, if I come into the market and I say, hey, you know what, I've got 10 million shares of this and that to sell, what's going to end up happening is that those 10 million shares are going to end up taking out all the bids, all the prices down, take out all the bids until you find a spot where it can't take out, where the size of the trade cannot take out any more bids and the price stabilizes. Okay? So I'm thinking to myself, now, what you get is you got these, what I'm going to call like these hot shot kind of hardcore traders, where, you know, to make a name for themselves, because they're in a big trading room and they compete amongst one another and their bonuses depend on how well they do. What if they did something like this? I'm looking at a price chart. Let's just say they could be daily bars or whatever. Okay, and this is like a swing high.